Present.
Secretary Props.
Here.
Mr. Jennings. Mr. Lavender.
I'm here.
Mr. Rawson.
Present.
Mr. Messina. Mr. Messina. Okay, where are we?
What's going on?
Where are we at? Mr. Messina? Okay. Mr. Tejas? Miss Allen?
Present.
Mr. Bingaman?
Present.
Madam Chair, we have a quorum.
Thank you, Andy. If we could move on to, before we do that, why don't we welcome our new members? We could have Treasurer Montoya. Would you like to say a few words?
Thank you, Madam Chair. Good morning. I am very happy to be a part of this board. I am Laura Montoya. I am from Las Vegas and Mora, and I live in Rio Rancho. We are on our 15th day and have our budget hearing today in Senate Finance and had our budget hearing in House Appropriations yesterday. I was very grateful to meet some of the members yesterday to discuss our packet today, and I look forward to working with all of you in this capacity. Thank you very much.
Welcome, Madam Treasurer. Secretary Props, would you like to say a few words?
Sure. Good morning, Madam Chair and members of the council. It's an honor and a pleasure to be with you today. Sort of like our new state treasurer, I'm, as you know, new to this position on my 21st day here at DFA, but very much looking forward to this part of my responsibility. Even though I'm new to fellow council members, I've known the staff and worked with the staff at the SIC for many, many years, probably more years than both Steve and I would like to admit. But it is I know I'm joining a very good organization, a well-run organization, and I'm grateful for the progress that the staff and the council has made on behalf of the people of New Mexico over the last decade or so during your tenure. So look forward to working with you.
Thank you, Mr. Secretary, and certainly you and the treasurer are new to this council, but not new to government for sure. So we very much welcome your background and expertise in our decision-making here. Next, we're going to move on to agenda item 1B, approval of today's agenda. Do I hear a motion for approval?
So moved.
I'll second.
We have a motion by member Allen, second by member Lavender for approval of today's agenda. Any discussion on the motion before the council? Hearing none, if we can have Andy take a roll call vote, please.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Props.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-0.
We have member Messina joining us as well, Andy.
Thank you.
All right. Let's move on to agenda item 1C, approval of our November minutes. Do I hear a
So
motion
moved.
for approval? Do I have a second?
Second.
Okay. We have a motion by member Lavender, second by member Allen. Any discussion on the motion to approve our November minutes? Hearing none, if we could have Andy take a roll call vote on approval of November meeting minutes.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
I'll abstain.
Secretary Probst,
I'll abstain as well.
Mr. Lavender,
Yes.
Mr. Rawson,
Yes.
Mr. Messina,
Yes.
Ms. Allen,
yes,
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 6-0.
Great. We'll move on to agenda item 2A and hear from our State Investment Officer, Mr. Moise.
Thank you, Commissioner, and I would like to echo your welcome to both Treasurer Montoya and Secretary Probst. The management group of the office has enjoyed speaking with both of them in order to properly orient each of them. And I thank Andy for putting together an excellent package of orientation materials, only totaling 500 to 600 pages. So moving on to my report. A new high watermark for our intra-month net asset value was achieved today. $42,383,796,000, up from 42.256 previously. So we're very pleased to see that. Even more important are the total distributions made to the state over the last 12 months as of the end of December. $1,217,443,000. As of December of last year, Commissioner, the total land grant permanent fund contribution from your office, from the State Land Office, was $219,521,176,000, even though that is on a 90-day lag. And Brent will have more comments on that unless you do, Commissioner. All
Not
right,
at this time.
moving on. Pardon me?
Not at this time.
Thank you. New Mexico oil and gas price, West Texas Intermediate, as of a year ago was $83.52. As of Friday of last week, $77.86. New Mexico rig count as of last Friday was 102, up from 95 rigs a year ago. Natural gas is a little bit harder to read in New Mexico. As of Friday, the US price was $3.17 per MCF. A year ago, that was a little bit higher at $4.45 per MCF. It's difficult to get New Mexico current natural gas prices. I do want to thank Secretary Probst, the other Secretary Probst, Wayne, for helping us try to get these numbers. She's been very diligent working with us from her office. We appreciate that. Moving on, if you will, with me on my briefing, we have covered items A and B. Also, item B, I think we've covered all of items B, numbered 1, 2, and 3. The fund balances, item 4, are reflected on the dashboard. You can consult that. Performance over what I think are appropriately important years, 3, 5, 7, and 10. Vince will go through, as will Marcia and Matthias from RVK, who are in the room with us. Under council matters, you see that the investment committee will be meeting on February 21 by Zoom. The council will meet on February 28 at 9 o'clock. We are still determining whether or not we will be able to go back into the cabinet room, and we will let you know. We have welcomed the treasurer and the DFA secretary. Again, happy to have them with us. Under operations, we'd like to introduce Ryan McCauley, our new fixed income analyst. Vince?
Yeah, so we fill up a new spot on the teams in the fixed income area. Tom, do you want to introduce Ryan?
I do. You caught me off guard a little. I'm not even sure where the button is to put on my camera here, so I'm just going to stay off camera. Yeah, so we're excited to have Ryan McCauley. Ryan, if you are on, maybe you can show yourself as well.
Yeah, my camera's on now.
There you are. So, you know, I personally am very excited that we have Ryan on board. Ryan has a great foundation in fixed income. He joins us from PFM Asset Management. He spent some time at the Montana State Board of Investments and received great reviews from Montana. He grew up in Utah, so he's familiar with this part of the country. So we're very happy to have Ryan.
Thank you. Happy to be here.
Thank you, Tom and Ryan. Under item D2, you'll see that we are looking for an analyst for our real return asset class, another legal assistant, future hires we have not yet posted will include another investment strategist for Vince's group, a private equity analyst, and perhaps others. So we are staffing up to handle this very large dollar amount of assets under management. You'll be hearing more about that in just a moment as Brent takes us through the IHR, the Internal Holdings Report. Under External Relations E on my briefing, I just commend to you, which is on the website, the 2022 External Audit Report. There are so many important facts in there. I know most of us don't think audit reports make for fascinating reading. This one does, and I commend it to you for your evening reading pleasure. The council orientation materials, which we have provided to the 2 new members, and we also provide to new staff, are also full of important facts about who we are and what we do. It's important for us to think about item 2E, or E2, if you will, assets under management and staffing over the last 13 years. Assets have tripled in value over this time period. The authorized number of staff members we can have has decreased, on the other hand, from what was 31 13 years ago to what is 26 today. I ask you, what's wrong with this picture? We will be talking more with you about that and how we might alleviate the issue as the months move on, but we will likely be needing to get authority to either do a budget transfer or a bar this year. Brent will comment on those things for us. Please do keep that in mind. It's a serious matter. I'm going to ask Charlie, if you will, at this point, to talk a little bit about client and legislative matters.
Sure. Thank you, Steve. Good morning, members of the council, Madam Chair. Regarding clients, the City of Rio Rancho has now deposited their $10 million into our client pools as of January. That was pursuant to an investment their voters made. They approved a deposit of $10 million, a Rio Rancho permanent fund. We're now managing that. We continue to get some more interest in The pools, I had a message on my voicemail this morning with an education ready part of the state. But we'll keep you up to date on that. We are at 27 clients and we manage $1.7 million for them. In other matters, the legislature, as you know, is underway. We're working to keep up with bill analysis that we've been requested to perform. We'll summarize the bills that we are tracking and that we're responding to in the weekly reporting that we get to on Friday afternoon. So far, we've seen bills that include up to a bill that would transfer $250 million out of the general fund to the Water Trust Fund. There's another bill that would reroute some additional excess returns to the severance tax fund. So we're keeping a close eye on those. We have a very good team working on FIRs, including our new investment strategist, Don Iglesias, Deputy General Counsel Bruce Brown, and myself. Andy is keeping all this organized for us and for Steve, and we work to be very responsive to legislative requests. We do have our budget hearing tomorrow in front of HAFC and a follow-up hearing with Legislative Finance Committee on Thursday. It is early days, but if you see any bills that you're interested in or that you are concerned about, please reach out to me or Steve and get back. That's the conclusion of my report.
Thanks, Charlie. Commissioner, either of us will be happy to stand for questions if there are any.
Questions for Charlie or Steve at this time from council? All right,
Thank
hearing
you.
none, we're going to move. Sorry?
Thank
Hearing
you.
none, we're going to move on to agenda item 2B and hear from our Chief Investment Officer, Mr. Smith.
Thank you, Madam Chair, and good morning, everyone. I literally have 2.5 pages of notes that I've foisted onto the CIC, but we'll compact them down for you a little bit. There is just so much going on right now. On the macro front, the Fed continues to fight inflation and is being successful. We're starting to see it down. I think the last print was a little over 6%, and our top was about 9%. So it is coming down. Top Fed funds rate now is 4.75%. Now, keep in mind, Fed funds that increases or decreases work into the economy on a lag. So, and it's about 9 months historically. So when the Fed makes a change to interest rates, that hits the economy generally about 9 months later. We look back, Brent and I looked back just this morning, and the Fed funds rate 9 months ago was 50 basis points. So there's 425 basis points, 4.25%. That the Fed has raised interest rates that theoretically, or at least relative to history, has not fully hit the economy yet. So we've got a lot more activity in terms of pushing back on inflation. It's actually becoming a little bit of a soap opera because the markets just don't believe it. We haven't seen the big downtrend, or haven't seen further declines in equities, and we continue to expect that. As the market thinks the Fed will pull off increases and actually start cutting rates a lot sooner than what Chairman Powell has indicated he intends to do. So we're watching that fairly closely. Even though only about 50 basis points of the increases, at least relative to history, have hit the economy, we're really starting to see things roll over. So we've got M2, which is a good measure of the cash in the system. So it's actual cash and highly liquid accounts is actually falling. That the last time that happened was back in the late 70s, early 80s, ahead of the really nasty 82 recession. So we've just not seen that. Savings have been drawn down by consumers. The savings rate's fallen to 5%. That's a very low rate relative to history. It was for comparison, it was 25% during the pandemic. That's a little high relative to history, but 5% is very low. Credit card balances are headed higher. We could sit here all morning. I could reel statistics off to you to confirm that these rates are starting to hit the economy, all the way from big ticket purchases such as cars, the housing, just across the board. rates are starting to hit the market. So we're keeping our eye pretty close on that. Still expecting another down leg in the stock market. Back when markets started to roll over in early 2022, we kind of sketched out where we thought it possibly could go. So just some guesses about where inflation might go. How high the Fed would have to raise interest rates to fight it. What sort of multiple compression, the economy likely go into recession. So how far would earnings drop on the S&P 500? Just a lot of mental gymnastics and scribbling on the back of envelopes, and came up with 2,500 on the S&P. Now that wasn't a forecast; it was just sort of a guess as to where things might go, so that we wouldn't be surprised as things played out. At the time, the markets were around 5,000, so that was a 50% drop. We did get down to 3,200, I think, was the low, somewhere in that area, and that's about where people were thinking the markets could go again. We're up around 4,000 now on the S&P 500. So we're expecting another little down leg, another substantial down leg here, and are prepared for that. But we're not. We haven't taken any kind of tactical moves in the portfolio. We're still about at our weights for equity, our target weights, which is about 40% land and severance. So we haven't taken any tactical tilts, but that's just the environment we continue to expect going forward here. Let's see. We can skip some of this stuff here. Yeah. So coming up for you, we've got a big agenda this spring. Our macro package is bigger than normal. Your annual investment plan 2024, we'll deliver that to you in June, but we're already starting to work on it. That'll be expanded. We should have a new section on inflows expectations, since that's been a big factor for us over the past year or so. In fact, for all of 2022, so Steve was talking about some of the inflows from the land office, which were fantastic during the year. But for all of 2022, 8.1 billion was the level of inflows. Not expecting that again in 2023, but still, we'll be talking about inflows in the annual investment plan. We're going to break out a new section on pacing. That's become a much bigger deal for us with the big inflows that we've had. So normally we put that with the asset class write-ups, but we're going to pull that all together into a consolidated section and walk through the pacing for you in a lot more detail. And then we'll return the portfolio analysis that we've done, expected growth, distributions, those things for you. We took it out last year just because the inflows just swamped our models, and we just weren't confident in some of those numbers, but we've gained increased confidence here as things are starting to slow down. So we'll have asset allocation studies for all of the funds, particularly land grant, where we expect a little bit of a change there. And the tobacco fund, the legislature is contemplating taking it out of reserves, which if it does, we can move that more toward a growth format and maybe make a little bit more money with the tobacco fund. The other funds, unlikely much change there, but we'll see when we address that. We'll have structure studies, fixed income next month, and the rest probably later on. Real estate, real return, maybe in August. Publicly traded equity in November, and likely the private equity portfolio structure study for you this calendar year. So a very full schedule we've got for you, particularly this spring, and the macro package, in addition to the run rate on investments that we've been making. Today's packet, as you'll recognize, that is pretty normal for us in terms of number of investments and where those investments are being made. Administratively, let's see. Steve mentioned the hiring. We're still looking for 3 investors. Keep in mind it takes us anywhere from 9 to 18 months to find the person that we need for any of our spots. A little bit longer if we're looking for an asset class director, but all these are analyst spots and one strategist spot. So they tend to be a little quicker, but the lead times up to 18 months on getting these folks in here. So just getting started on a couple of these. And I think, Madam Chair, won't bore you with the rest of this stuff, but we'll stand for any questions that you have.
Maybe my audio cut out. Are you finished, Mr. Smith?
Yes, yeah, stand for any questions that you have, Madam Chair.
Questions from council? Okay, hearing none, we'll move to our monthly performance report for November from Vince and RBK. Agenda item 2C.
Madam Chair, I'll pass right to RVK. This is just our monthly. We'll spend more time with you next meeting with our December numbers, but let me pass over to RVK.
Thank you, and good morning, everyone. We do have the November preliminary flash report for you. It's preliminary in the sense that given that it's a mid month or mid-quarter month, private markets, of course, are not quite available just yet, but we do have a good read on the public markets and giving us an indication of how performance is shaping up. I think as you look at these numbers, and we can take a look at it's page 23 in the meeting materials, page 2 of our report.
It's page 20.
20, yeah. Apologies for that. Page 20. That's our capital markets overview. Has all the highlights here. You can see market performance on the bottom right there. A lot more positive numbers than what we were used to seeing for a good part of 2022, where it's mentioned in his comments that was a fairly persistent sell-off. We've talked about how pervasive it was, not just across risk markets, but also across the fixed income markets, as we've seen interest rates make very substantial moves, particularly given how low the starting point was. We did, of course, come out of a bad September where the sell-off was also fairly pronounced, and the bounce back that we saw in October extended into November. So that was really nice to see. A lot of that came from relatively resilient corporate earnings. We saw inflation data at least showing signs of softening, although we're a long ways away from the Fed target. And that led to some market hope that the Fed could potentially put some brakes on future interest rate hikes and further tightening, although that's fairly unlikely at this point. As said, that they're committed to further tightening and getting inflation under control. So very much aligned with Vince's comments that there's still a fair amount of optimism in the markets that's probably somewhat misguided at this point. So while this was a nice tick up, you can see that calendar year to date, that's under the CYTD column, still fairly negative, particularly across the public markets. That's a portfolio of the public markets, your equities and fixed income that's been praised for the past decade of cheap money and lots of liquidity. We're seeing a very different environment now, and been thoughtful about that and position the portfolio accordingly. And I think your results, as you'll continue to see, are going to show the benefits of that. So a bit of a break here, but December was more of what we were used to in 2022, bit of a pullback. Fortunately, the fourth quarter in aggregate, so taking your October, November, and December, which we'll bring to you next month, managed to eke out a positive return. We still have a fairly long way to go in terms of the 2022 numbers that you see here. So ways to go, and more work to be done there. In terms of diversification, as I mentioned, I think you're very well positioned, well set up, continue to benefit from this type of environment. Fixed income probably is the area that saw the biggest move. Looking at that top right-hand chart, the yield curve, you can see just how much it's moved in a very short period of time, from essentially rates that were scraping at the bottom to now rates that are north of 4%, more or less across the curve, higher on the short end than on the mid and long end, and that inversion of the yield curve has been a precursor to recessions in the past. So that is something that folks, of course, are also keeping an eye on. At least as a form some level of caution. But this changing, and as we're working through our capital market assumptions, in fact, we just had our triangulation call, which is sort of the culmination of that effort. Before we finalize our assumptions, fixed income probably saw the biggest change in terms of forward expectations as a result of exactly that chart. And so we'll be bringing you those numbers and implications on the portfolio and outlook in the coming months. So I'll pause here. Glad to take any questions or comments, and otherwise turn it over to Marcia to give some of the fund performance details.
Thank you, Madam Chair. I'm going to take you to page 22 of your packet, page 4 of our report, and at the bottom you can see performance. But just again to comment, Matthias made the point that during these inter-quarter months, private investments are held at zero. So these are all monthly or are always preliminary reports. And as Vince said, we'll spend more time when we have the December report for you. But as Matthias said, pointed out, there was a positive month for the month of November. The total New Mexico, the total fund was up 3.5%. For the quarter, you were at 5.59. Now I will say that December took some of that back for the quarter. Land grant positive 3.65, and the same exact return for the month for the severance tax. So a positive return for the quarter and for the month, and that ended up with a fiscal year as in positive territory as well. Looking up at the right-hand side of the chart at the top, we're looking at your target allocations for the land grant and the severance relative, your current allocation relative to the target. Vince is going to talk some more about this a little bit later in the presentation, but just noting, we call this a high-class problem because of the inflows that you have and the markets that we see now. You'll notice that you have an allocation to cash, and with a zero target and a above target allocation to fixed income. And as I said, Vince is going to spend more time on that a little bit later today. I want to point out on page 23 and 24 a couple things. You will actually see in a moment some calendar year to date returns that are positive based on the numbers that Matthias gave us earlier. How can that be? Well, not all your allocations are the same, as you know. So there are portfolios that have no allocation to public equity, and there are some that have very low allocations to public equity. So if you're looking at tobacco, water, they have 20% in equities, which is a lower allocation, land grant and severance. Early childhood, even lower to public equities, and rural libraries and tax stabilization, no equities in the portfolio. So if you go to page 25 of your packet, and you can see the calendar year to date returns for land grant. We saw earlier that they were negative over 5%. For both land grant and severance on a calendar year to date basis. If you look at the bottom of this page 25, you see actually a positive calendar year to date return for tobacco. And again, why is that? Low exposure to public equities. And that carries through on page 26 for the water and for rural libraries as well. So just wanted to make that point. Page 28 is looking at the composites. Again, at the top, you can see for the total fund for land grant and severance. And then each of your asset class composites down below, U.S. equity, positive return, as Matthias pointed out, both for the month and for the quarter and fiscal year to date. Non-U.S. equity, even better. That was a weaker dollar. So it was nice to see positive returns for those periods. Core fixed income also positive for the month, and in this case we haven't seen this for a while. Actually, core fixed income beat non-core fixed income for the month. But if you look at longer term returns, you can see that having that non-core diversification in your portfolio is really added value and through diversification. And then bottom, because you do have some cash, we give you cash returns. On the next page, you'll see a lot of zeros. Again, those intra quarter months are held at zero, as Matthias and I both mentioned. The exception to that is a very small allocation of financial assets, which has 2 sub-asset classes and some short-term mezzanine. It actually had a positive return for across the board there. So it's a very low allocation. So a couple ending comments on page 30, just looking at attribution. We typically don't look at attribution for the month, but we thought we would for this month. You underperformed your strategic target allocation for the month. Why is that? Down below, we try to break it out, but being most of your return came from your allocation, as you can see. With a positive equity market, most of the return came from U.S. equities and non-U.S. equities. The second column, which is TAA, that really tells you, any deviations from your policy. So not being at your target allocation actually was a slight negative for you. In particular, you weren't at your target weight to non-U.S. equity or slightly below that because non-U.S. equities did quite well for the month. So that was a headwind, and not being structured is exactly like your benchmark. That was a slight headwind. And then your managers didn't add value in the month, and that's the negative 0.26. So going though to the next page, this is looking for the year where you actually lost less than your policy index. And why did you lose less? Well, part of that it was manager value add, and that's the far column. So your managers contributed, that's the purple line. So managers added value above their benchmarks. I will point out the yellow was a negative, and that is deviations away from your policy index. You have not been able to get at your policy index. Part of that is the money that you have coming in, and getting to your private, you can't just put that in the private market. So being away from your policy target was a bit of a headwind. Again, high class problem. You actually have money coming in, but it takes a while to get it invested per your policy index. And with that, Madam Chair, we'll take any questions. Unless Matthias says.
Thank you, Marcia. Thank you, Matthias and Marcia. And so questions for RVK.
Madam Chair, one question.
Madam Treasurer.
Just to clarify for myself on page 25, those are unrealized losses, correct?
25. The gains and losses, that's all that. Is it all some would be realized.
Yes.
So it's unrealized and realized.
Correct. Yep, Madam Chair, to the degree our managers traded over that period, and they did over a full year period, most of our managers would have traded. It's likely they took some losses, but most of that's going to be unrealized.
Thank you, Madam Chair. And then as far as your benchmarks, when are you reviewing your benchmarks? How frequently, or what is your process?
At the allocation level, well, at the asset class level, we review those with the asset class structure studies. Those happen anywhere from 2 to 3 years, 2 to 3 years between them. And then the benchmark at the top line is just a summation of those asset class benchmarks. So every 2 or 3 years for each asset class. So it's sort of on a continuous basis.
And then if there is an allocation change at the upcoming allocation, that would trigger a change to your total fund benchmark too, just to be reflective of your allocation change.
And the last question, to your point on the managers and being able to invest a little bit quicker, what process are you looking at to be able to do that with the inflow of funds coming in?
Right. We do what we call pacing models, and it's just for each of our private asset classes, and they're complex, but we try to estimate how much we need to invest in each of these asset classes per year to get us to our targets and keep them there. So it's a long-tailed sort of processed, and it's nothing really where we can make changes. We could try to put more or commit more money to the markets, outside of the pacing model, but likely it would push us away from our long-term targets. So it's just, we know in advance each year how much we need to commit to try to stay at those numbers or try to stay at those targets. So it's sort of a locked in, in any given year, it's a locked in number.
And add to that with the pacing is that you don't want all your money to go into 1 year in private investment, so that you have the pacing that you can actually accomplish, but you also want to spread that out over different vintage years.
These investments that you'll see today, Madam Treasurer, those commitment levels that we'll be showing you, those will get drawn down anywhere from over a period of anywhere from 3 to 5 years. So we try to take that into account. Those managers can't put that money to work immediately. So investment periods tend to be between 3 and 5 years on these commitments. So that's what we're mainly taking into account.
Thank you, Madam Chair.
Commissioner.
Thank you, Madam Treasurer. And did that answer your questions? Okay, so are the most recent updates to the asset class studies and the pacing models available for the treasurer if she'd like to see them?
Sure, Madam Chair, absolutely. We could provide those. Likely, she'll want a briefing to go along with them because they're lengthy and complex.
Well, just in terms of how we're making those investment decisions, I think that might be valuable. That's available to you if you'd like. And I think I saw Steve raise his hand. You're about 10 centimeters big on my screen here, Steve. Did you raise your hand?
That's a real treat, Commissioner, because it's usually just the opposite. Commissioner, I would just like to mention something I should have mentioned in my briefing. We are very pleased this morning to have a guest with us. His name is Michael Hidalgo. Michael's father, Peter Hidalgo, was the state investment officer from 1975 to 79. So, Mike, thank you for being with us today.
Thank you for letting me.
Holy cow.
Public.
Welcome, sir.
Thank you. Thank you very much. I appreciate it. I guess I'll jump on the screen just so.
Thank you, Commissioner.
All right. Any further questions for RVK or Mr. Smith before we move on to our investment matters? And folks, we've got 7 voting items today, so just a reminder to keep things moving. Hearing no further questions, I'm going to turn it over on agenda item 3A to our committee chair, Mr. Lavender.
Good morning, and thank you. I think tell Laura and Wayne to get ready because every about a week before each council, you're going to get the 500 to 600 pages that Steve referred to when he talked about your orientation. Just get ready for that because that's every month now. And you can see, as the commissioner just indicated, we've got 7 investments today, and based on what Vince told us at the committee level, this is not going to be unusual. With all of the inflows, we've got Vince had spent quite a bit of time talking about the challenges that we have to get that money invested and put to work. It's a great problem to have, but it's an actual problem relative to getting it properly placed. So I know we're going to continue to, you'll hear lots more about that. And I know Vince is going to even speak some more about that towards the end of this section, having to do with potentially raising the asset class maximum due to the fact that we have so much money coming in and so many things happening. Anyway, that's what I have. I'd like to do this, Madam Chair. We've got, again, 7. I'll just say this now so that we can just move more rapidly. All of the committee unanimously recommended approval of all of the investments except 3C, and Lee indicated he had an issue with the ESG provisions of that particular investment, and I'll obviously let him, he'll want to say something, I'm sure, when the time comes for that one. Other than that, Madam Chair, these were unanimously recommended to the council for approval. And I'll turn it back to you to take it down the line.
Wonderful. Thank you so much. And we're going to actually move on to our very first voting item. It's agenda item 3B, a recommendation for a $100 million investment into Almanac. I'm going to have Mr. Sable kick us off, then turn it over to Townsend and any representatives from Almanac we have on with us. So Mr. Sable, if you could kind of run that for us, that would be great.
Great, my pleasure. Thank you, Madam Chair. Joining me this morning is the usual cast of characters from Townsend. So we'll have Seth Marcus, Stephen Hertenstein, and Teddy Grodzinski. And then for this investment from Almanac, we'll be joined by Josh Overbay. As you mentioned, we're recommending a $100 million commitment to Almanac Realty Securities 9. This would be SIC's fifth commitment to Almanac, with the initial allocation made in the Series 4th vintage. The fund targets low double-digit returns, net 50% of which would come from income and 50% from capital appreciation. Fund's history goes back to being a spin out from Rothschild Realty when the current firm's founders spun out in 2007. Recently, they were part of a transaction in which the firm was acquired by Neuberger Berman. Post the transaction, Almanac independently operates on the Neuberger platform and continues to be run by the prior leadership team. And so we're confident in the continuity of the investment process that exists there. The fund strategy is to provide growth capital to experienced real estate teams with strong value add or opportunistic strategies and portfolios with clear growth prospects. What's unique about this investment is that they follow a balanced investment style where they're taking positions through convertible securities or other blends of equity and debt sensitive instruments. They are structuring these investments to capture substantial income component to the return stream while also preserving the ability to capture the upside created by the portfolio's investees. The GP thinks they have a sourcing advantage because they're viewed by potential investees as an attractive partner. That's a reflection of the terms being a bit more user-friendly than what they would run into in typical financings provided by mezzanine lenders. Still, the way the investments are structured, the partners of those investees retain autonomy over day-to-day execution of their business, but major decisions like acquisitions, capital raises, management changes, or asset dispositions are overseen by a joint board where control is shared between the partner and Almanac. And then ultimately, to protect our investments, there are springing director seats that are tied to pre-negotiated covenants that enable Almanac to assume control if and when that becomes necessary. A couple of key reasons why we like the investment. One is the balanced, so meaning mix of equity and debt in the portfolio structure that presents a diversifying influence on the real estate portfolio. Specifically, we would expect the fund to be somewhat less volatile than value add or opportunistic strategies that underlie the investment strategy followed by the GP. We'd expect it to perform relatively well against those categories when they're weaker and vice versa. Prior vintages have performed at or near their investment targets. And it's important to note that this strategy consistently ranks near the median against both value add and opportunistic peer sets, those peer sets being equity-oriented funds. And that's despite the fact that this fund's structure is a more balanced mix of equity and fixed income-like exposure. The fact that it does perform like that is a strong indication of strong risk-adjusted performance. So in summary, we are recommending both Townsend and the SIC staff that we make a $100 million allocation to Almanac Realty Securities 9. With that, I'll turn over to Seth, and then Seth, if you would pass over to Josh when you're complete.
Sure. Thanks. Thanks, Keith, and good morning, and everyone. Happy New Year. It's been some of you haven't seen since December, or actually November. So good to see you. And congratulations to the new members as well. So before passing it along to Josh Overbay with Almanac, I'll do my best to keep this brief. I know it's a full agenda. But this is a manager and a strategy that you've heard of before. It's in our portfolio. We've approved over the years. In fact, our last commitment to Almanac Fund 8 was also done in January. It was January of 2018. And as noted in our materials, we've made multiple commitments to Almanac over the years. So as of the third quarter data, which is where we have the data we have for private equity real estate, our exposure to Almanac as a manager was about $75.7 million across 3 existing funds. We also have about $40 million of unfunded capital that remains in Fund 8. This capital has been committed by Almanac, just not yet called or funded by the SIC. We also have prior exposure to Fund 4. Fund 4 was fully realized in 2017 at a 9.3% IRR and a 1.5 multiple. The 2007 vintage Fund 5, we actually skipped. We did not invest in that one. This was due to a pause at the SIC and from making investments during the global financial crisis, as well as restructuring of the investment staff, the council, and the consultants, the consultants for the board or for the council. So, as Keith mentioned today, this is a $100 million commitment that we are recommending. This would represent our first real estate investment of 2023, and when including this proposed commitment and prior investments that I just mentioned, our exposure to Almanac within the real estate portfolio would be about 4.5% on a funded and committed basis. Almanac is continuing its successful track record in Fund 9. The fund, as Keith laid out, will make private placements of growth capital to real estate operating companies, really with significant real estate assets, targeting returns as noted in your presentation. The important part, and Keith highlighted this, and I'll just reiterate that on this investment, is that approximately 50% of this return is expected to be driven from income, which is consistent with past funds, but also provides a tremendous amount of downside risk. And when we think about portfolio construction, we look at balancing out our exposure to both appreciation and value creation funds, as well as more income-oriented vehicles. So in short, the strategy is really a mix between private equity and debt. Almanac provides that growth capital to real estate operating companies that have property portfolios with existing cash flows and value add potential, and then companies with significant real estate assets that are very integral to their business. This is an entity level investment that Almanac makes, typically in the forms of that convertible debt or high coupon rate of 6 to 9% that has previously been discussed. I think interestingly that the underlying properties that Almanac will ultimately own or invest in through these structure can be traditional property types, the office, retail, industrial, and multifamily that we're used to, as well as specialty property types, so self-storage, hospitality, senior housing, medical office, and others, and really further diversifying the SIC's portfolio. As can be seen in the track record in the fund series, Almanac has executed this strategy really since 1996, and has invested over $6 billion into 43 transactions, generating strong returns. And again, a majority or 50% of that is coming from income. As typically outlined in our recommendations to you all, we do identify a number of competitive advantages as well as potential issues and concerns. Instead of going through each of those, I'll just maybe point out one of each and sort of the high points on those. At this point in the market cycle, Townsend really does prefer to invest with deep, well-resourced managers with an established track record that also provide a lot of that downside protection that I mentioned. Not only does Almanac check this box, but they do so with an established team, a long track record and history of doing so, and a really high fiduciary standard. As I mentioned, in addition to competitive advantages, we highlight a few potential issues and concerns. The one I will just take a minute on and is a new one that was not in your report back in prior investments, and that is the ownership change that Keith mentioned. You'll notice we have this as both a potential risk, but also as a competitive advantage due to the additional resources that the Neuberger-Berman team provides the Almanac platform. And importantly, the Almanac partners do maintain control and brand and autonomy within the organization and continue to run the Almanac platform. I will wrap my comments up there. Just mention that for all these reasons, Townsend investment committee has approved and recommends $100 million commitment to the fund. and approved by our investment committee on a standalone basis, as well as for the SIC's portfolio. I'll stop here and hand it over to Josh Overbay at Almanac.
Thank you, Seth, and thank you, Keith, for the kind introductions. Hopefully everybody can see me and hear me. I realize I'm the pace setter for this section, so I will attempt to move through this expeditiously. And I think the presentation is included in your larger packages. I think I was told that the Almanac section begins on page 94. Or sorry, I think it's 91, but I'll begin on page 94 with a brief overview. And first, let me say thank you, to Keith and to Seth and the whole Townsend team for all the work that they've done in underwriting the continuation of this partnership. As mentioned previously, the proposed investment would be the fifth fund that the state has invested into in partnership with Almanac, and that partnership extends back about 18 years, I think, to Fund 4. So on behalf of everyone at Almanac, thank you for that very long-standing partnership. Just briefly, I'll be referring to these pages if anybody wants to follow along. As mentioned in Keith's opening comments, our team has been around for a long time, really 42 years, since founding, 27 years that we've been executing through this flagship series of funds. 1996 was the marker of Fund 1, and of course we're raising Fund 9 today. As mentioned, at a very high level, our strategy is to provide capital for growth to what we view to be best-in-class real estate operating companies. Those companies tend to be specifically focused on one property type. So most of them are very focused on either industrial or multifamily or whatever their particular area of focus might be. And over the course of a fund, the idea being that we build a portfolio that is diversified, both from a geographic standpoint as well as from a property type standpoint, and that we're partnering with these companies, as mentioned, in a way that allows us to get contractual fixed income, combined with the ability to participate in the value increase of the underlying real estate. Over that period of time, we've invested in 51 of these companies, so deep experience on that standpoint. We've committed over $7 billion of capital to those companies. This is not a high volume strategy. We tend to take a long period of time to get comfortable with these management teams before we complete an investment with them. We tend to make 2 investments per year, so very measured pace. Over that period of time, we've delivered just under a net 13% return to our investors through thick and through thin, through a lot of different market cycles. As mentioned, our global financial crisis vintage fund, which really was Fund 4, the first fund that we partnered with the investment council, has delivered north of a 9% net return. So, in keeping with Seth and Keith's comments, we're very proud of the stability of our track record over that period of time and the relative lack of volatility based on the way that we invest. Underneath it all is real estate. The 14 companies that we own interest in today own and control about $29 billion of real estate. So even though it's relatively concentrated from a number of companies standpoint, underneath it all is a deep pool of diversified real estate across all different markets and property types. As was mentioned, we did partner with Neuberger Berman back in the beginning of 2020. I'm going to flip and refer to page 95, the next page, just a brief snapshot on the firm. We viewed it as being a very positive development for us. We're now part of, a very long-standing firm that's been around for almost 85 years. There are 2,700 employees in over 20 offices worldwide. The firm manages over $400 billion of client capital. Neuberger Berman as a firm is, pretty much every year voted number 1 or number 2, best place to work in money management by Pensions and Investments. That's certainly been our experience here. And we are the primary real estate strategy within the firm. So Almanac's $6 billion plus, a few other strategies comprise the bulk of the real estate business at the firm. Flipping over to page 96, I'll just talk about our team quickly. I'm one of 6 partners and investment committee members at the firm. Overall, our Almanac group is 44 individuals. The average tenure of the partner group and the investment committee group at the firm is over 20 years. So very long-standing team. Matt Kaplan, our chairman and group head, started with the firm back in 1990. Another one of our partners started in 1988. My 9-year tenure is bringing that average down. So I'm the sort of rookie of the partner group and the investment committee group, and very long-standing team and dedicated to what we do. On page 97, this is just a brief snapshot of the current portfolio. So 14 active investments, different portfolio companies, investing in all different strategies and in all different geographies. And again, I think it bears repeating that, underneath these 14 companies is a very deep portfolio of real estate, almost $28 billion, across the different companies that we own an interest in. The next page, 98, is a breakdown in terms of, where are the exposures, where is capital invested. The bulk of the capital that we've invested to date has been in the residential sectors and industrial. And I'll include in that self-storage, which is the first investment that we've made in Fund 9. So, across the board, these holdings, it's 1,500 individual assets. It's 90 million square feet in terms of that portfolio, and diversified, again, across quite a few. The track record I touched on, which is on the next page, it's a 12.6% net over 27 years. We're very proud of that. And again, as has been mentioned, the history has been about half of that total return, north of 6% on a net basis, has been in the form of current income. And most of that current income tends to be contractual in sort of a fixed income security. And that is then combined with our ability to participate in the equity upside through warrants or preferred equity or common equity. Page 100 is just a breakdown of what those securities look like. So we show Fund 6, Fund 7, Fund 8, and then on a combined basis. These portfolios tend to be roughly split a third between our investments being in the form of common equity, preferred equity, and then debt, to achieve the seniority and the capital structure of these companies that we like to invest in. And one important thing that I want to note is the management teams of these companies that we're investing in are large owners of these companies themselves. We're typically requiring them to consolidate and roll up all of the equity that they have in their companies. Oftentimes that is a range between 20 million and sometimes over $100 million of their own equity that they have invested in these companies and in these portfolios. So we feel like that's a great alignment of interest, and that also provides a good equity cushion to our senior securities that are getting that fixed income type return. And then finally, I'll wrap it up with page 101. This is just a further sort of breakdown of where the exposures lie in Fund 8, our most recent fund that the council has invested in. There's a pie chart that shows the different breakdowns of the property exposures we have. 72% of Fund 8's portfolio is invested in industrial, multifamily, or multifamily debt. And what I mean by multifamily debt is we have one investment in a company that their business is originating loans to other multifamily owner operators. So we certainly feel good about the strength and momentum in those two sectors. I would expect roughly the same for Fund 9, obviously one investment in self-storage. We're close to finalizing a second investment in multifamily. At the end of the day, I would expect Fund 9 to look very much like the previous funds, probably 7, 8, or 9 investments in a diversified portfolio of assets. So I'll stop there. I'd be happy to answer any questions if they are. And thank you again to everyone for the time and consideration today.
Great. Thank you to Mr. Overbay for being here with us today. And thanks to our team and to Townsend for the presentation. I see a question from member Allen.
So a question about exposure in Europe. How global are the investments that you make and how much of those are in Europe?
Today, really none of them are. I should have mentioned this, but our focus really is on the United States. And that's where I would say 95+% of our exposure is. There is one company that we've invested in that has the bulk of their business is in the United States. They also own a smaller portfolio of assets in Europe, but I would not categorize them as a European real estate company. They just happen to own a small number of assets there. But historically speaking, and the expectation for Fund 9 is the vast majority, if not all, of our investments will be oriented to companies that are owning and operating real estate in the United States.
Further questions? Hearing no further questions on this recommendation, do I hear a motion?
Madam Chair, based on the recommendations of the Council Investment Committee, Consultant Townsend, SIC staff, and general fiduciary oversight of RBK, I move the State Investment Council approve a commitment of up to $100 million to Almanac Realty Securities 9 LP, subject to and contingent upon New Mexico legal requirements, the Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
I'll second.
Who was that?
That's Lee.
Lee.
Secretary.
Okay, we've got a proper motion by member Lavender. I believe a second by member Rawson.
Yes.
Okay, with that, we're going to take, actually, is there any discussion on the motion? Madam Treasurer.
Madam Chair, I would just say that I really appreciated the presentation and the documentation inside for my first action item. It was very detailed and answered about 13 questions I had, so thank you.
You wrote them down and numbered them, I'm sure. Thank you, Madam Treasurer. Any further discussion on the motion before the committee? So we are voting on a recommended $100 million commitment to Almanac Realty Securities 9. And hearing no further discussion, we're going to have Andy call the roll.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Probst.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Ms. Allen. Oh, thank you, Mr. Messina. Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 8-0.
Very good. And we thank the folks from Almanac for being on with us today.
Thank you very much.
Okay, with that, we're going to move to our next voting item, agenda item 3C. This is EQT, and I believe, if I have this right, it's an initial $160 million commitment and then a co-invest of an additional $60 million. So for a total of $220 million. Is that correct? Can someone give me a thumbs up in the boardroom?
That is correct.
Seth gave me a thumbs up. Okay. So I know that this is the investment that Member Rawson has some issues with. So Member Rawson, I will allow you some time to chat about your concerns after the presentation, if that's okay.
Yeah, that's fine.
So, okay, and with that, I myself am also very interested in the ESG policies of this group. So if we could focus some of our discussion on that, either from EQT or from our consultants, that would be great. So I'm once again going to turn it over to Mr. Sable, if he could give his comments and then call on Townsend and whoever we have on from EQT.
Thank you, Madam Chair. As you pointed out, we're recommending a $160 million allocation into equity or EQT infrastructure 6 and $60 million into a co-investment vehicle. Joining me from the manager today are Darlene Salmon and Masoud Homayoun from Sweden, actually. And I wanted to thank Darlene for her help in deconflicting the Zoom meeting by running a test session with us during the day yesterday. We're really excited about EQT infrastructure. They're a best of breed manager, investing globally, principally in developed markets with an emphasis on Europe. While these commitments to EQT would be our inaugural investment with EQT from an infrastructure perspective, SIC has made several other allocations to EQT portfolios, including on the real estate side, EQT Exeter, who's been in front of council numerous prior occasions. As with prior funds in the series, the GP intends to focus across a number of key sectors, including digital, energy, transportation and logistics, environmental and social themes. Prospective investments will have the potential for growth and margin expansion, as well as defensive characteristics that include strong position in markets for critical services, contractual cash flows, or asset-heavy balance sheets. The fund will be a large one that will be making up to 15 to 20, 200 to 1 billion euro checks across their investment portfolio. To avoid repetition, I'm going to avoid getting too much into the details of the investment strategy and leave that part to Townsend. Points that I want to emphasize as key reasons why staff is interested in the investment include the high level of performance that the manager has demonstrated over time. Through prior vintages, they've been consistently a first or second quartile performer. Townsend actually has estimated that over the prior 5 vintages, the management has generated an IRR in excess of 17% net, with more than half of the prior portfolios realized. We acknowledge that ESG is a key component of their investment value adding process, but it is one of multiple components for adding value in the portfolio management process. And we would highlight that they generated extremely high returns. And so the focus on ESG has been a mechanism for creating value as opposed to one that puts them in handcuffs. I think the other key thing that I would like to emphasize is the diversification benefits that we will gain by incorporating this portfolio into the real asset portfolio. In particular, it will add weight in areas where we consider the portfolio to be light, and will put less emphasis on areas that we consider to be heavy. One way of looking at the diversification component in the portfolio is through geography. The real asset portfolio is very heavy tilted toward domestic assets, and because the manager will have the latitude to invest as much as 60% of the portfolio in Europe, we expect that will help shift the mix back to a bit more balanced structure in the fund. Also, from a sector perspective, we find that the real assets book is underweight in some key growth sectors, including communications, also on the transportation and potentially logistics sides, and maybe a little bit overweight in data centers. We believe, again, that the historical emphasis of sectors in the portfolio will cause our overall portfolio exposures to mitigate those overweights and underweights, and potentially add some desirable exposures in areas like communications subsegments, including fiber and towers. We looked closely at the alignment of the portfolio, particularly from a fee perspective. We note that the rack rate is a bit higher than what we would like. Potentially the pref is lower than average, and the catch up after the pref is somewhat higher than average. We think there are a couple of key mitigants in this that we've considered. First is that we're going to be getting first close economics, and then subsequently at a commitment of the size that we're considering, the fee schedule is dramatically improved versus what the rack rates would look like. Assuming that the co-invest is materially drawn, the blended mix of economics related to both the co-invest and the fee actually come out to be a compelling balance. Given the balance of factors that we considered, both in terms of investment process and economics, staff and Townsend are both recommending this recommendation at a $220 million aggregate level. With that, I'll hand off to Seth for Townsend's underwriting, and then Seth, if you could pass the baton to Darlene when you finish.
Absolutely. Thanks, Keith. And again, I'll venture to keep this brief. I don't think I did a great job last time, but I'll try here. So just as a recall and maybe some background for the new members, the SIC has a 10% allocation to real return. 80% of that, or 8% of the total value of the fund, is targeted to real assets, which in portfolio within the real assets portfolio is defined as timber, agriculture, energy, and infrastructure. With our timber and agricultural portfolios largely built out, and additionally with a significant amount of upstream and midstream energy exposure, our focus over the last really year plus and going forward to some degree, our focus on new commitments is really targeted towards the infrastructure investment opportunities. This would represent the first real assets commitment of the year, therefore our first infrastructure commitment of the year. In 2022, we made 5 infrastructure commitments, all to follow-on investment managers that we had invested with in the past. And as Keith mentioned, this is a new manager on the infrastructure side for the SIC. The fund basics, just to put it out there, and then it's in your materials, but this is a 20 billion euro denominated fund, closed end. The target return is in the low to mid teens, with a large percent of that coming from value creation, limited cash flow in this strategy. And really a value add risk orientation. The areas of focus include digital infrastructure, energy, transportation and logistics, environmental and social infrastructure. From a geographic standpoint, about 40 to 60% of the fund is anticipated to be invested in Europe, and then 40 to 50% in the US, with the balance, with the ability for the balance to be invested in the Asia Pacific region. The primary reasons that Townsend recommends this investment is very much so the compelling track record, and that's supported by realizations. EQT is a cycle-tested manager with over 14 years of investing in infrastructure. The combined infrastructure IRR over that time, as Keith mentioned, is just under 18% and a 1.4 equity multiple. And this is on 52 investments and $22 billion of 23 billion euros of drawn commitments. The first 3 funds are top quartile performers across all metrics relative to similar vintage infrastructure funds. And this included in the track record is 21 fully realized investments generating about a 28% gross return and almost a 3 times multiple. EQT has demonstrated discipline in selling investments and realizing returns within the first 2 funds that are fully realized, as well as the third fund, which is substantially realized at this point. Performance has been consistent across sectors, across geographies targeted in the fund, with a very low loss ratio. So the loss ratio being how many investments have delivered a loss of capital, really just 2%. So 2 out of 52 investments have had a realized loss at less than cost. So low on a relative basis to peers, but also on an absolute basis. Additionally, EQT has a very unique platform strengths, and that's due to the senior team and what they call their industrial advisors. So EQT is a very large infrastructure team, part of the top tier asset managers across private equity portfolios and geographies. And 3 of the founding members of EQT are still partners in the business today and very active, and created a very strong and culture that has been established and maintained throughout the firm's history. The firm differentiates itself from its peers with really with the breadth and the depth of the networks that they utilize from the senior and what they call industrial advisors. We see these as sometimes or board members that infrastructure managers put in there on their funds, but these are really established presence in the vehicle. These are senior level executives that act much more part of the dedicated EQT organization and team, than we observe in other infrastructure investment opportunities. They're actively identifying market opportunities, sourcing deals, contributing to the underwriting assumptions, and really ultimately manage the investment through that board participation. As I did with Almanac, and as Keith mentioned, we always do highlight a few potential issues and concerns. The theme across the ones we've highlighted for EQT is both the fees and the governance, which Keith went into depth on. So I won't follow up or reiterate anything that he mentioned. On the ESG front, I'll leave it to the experts and let the team at EQT sort of highlight how they think about ESG relative to their investments in their portfolios. But given the strengths that I previously mentioned and Keith's highlighting the portfolio fit of this investment opportunity, Townsend believes that a commitment to EQT is appropriate for the SIC at the $260 million or 260 million euro, $260 million level for this investment, and has been approved again by Townsend Investment Committee on a standalone basis and on a commitment relative to the SIC. So with that, I'll hand it over to the EQT team.
Seth, I think 220 is what you meant, right? It's 160 and an additional 60.
Madam Chair, that's correct.
Co-invest.
That's correct. Sorry, I stumbled over that. Thank you.
Right. Thank you, Keith and Seth, and thanks everyone for having us here today. My name is Darlene Salmon, and I co-head our client relations efforts for EQT in the Americas. We've maintained a good dialogue with, I think, the staff in Townsend over the years, and obviously have a good partnership on the real estate front and some legacy relationship on the private equity side. And so we're excited about the opportunity to hopefully establish a partnership with you in infrastructure, particularly given the development and needs of your program, which Keith mentioned. It's an incredible mission that you serve for the state of New Mexico, and we truly hope that we can support you in those efforts. I understand that you do have some questions on a certain topic, which we're more than happy to address. But first, I'll turn it over to my partner, Masoud Humayun, who's dialing in from Sweden.
Hi, everyone. Also from my side, appreciate you taking the time to discuss with us. As Darlene said, I'm calling in from Sweden. Unfortunately, I have this background as opposed to it's dark, as you can imagine, right now in Stockholm. So it wasn't more exciting than this. I figured I could have this background. But look, I think just very shortly on me, I've been with EQT Infrastructure since inception, so approaching 15 years this year, where we have invested, the 5 funds that was referred to. And part of a partner group at EQT Infrastructure, where we're 18 partners and majority have been part of the team since inception, so very intact. If I've understood correctly, you do have our presentation at hand, so I think the only thing I will do is just use one of those pages in terms of reference points, and otherwise keep this as a short presentation and then go to Q&A where you have questions. I understood you have it as part of a bigger presentation, so I don't know the page numbers, but it's effectively the first overview page, which reads EQT Infrastructure, an industrial approach to infrastructure investing. So it should be page 4 in that deck that we provided.
Could we just, Mr. Humayun?
Humayun, yes. Masoud is fine.
Could we get the larger packet number, page number that we're starting on? From staff, Seth? What is it? I'm sorry?
172.
Okay, thank you.
I'll just skip to 172 then. And my intention was to give you an overview of our focus areas in terms of infrastructure investing, the team, what I think are some of our differentiators, which has led to the results that were mentioned here. And really take that as the kickoff point for your Q&A. Before diving into what we're doing today, I think it's worthwhile just spending 30 seconds on our history, because it does impact our way of operating and some of our differentiation that was mentioned here. So EQT, which has a 30-year history, was founded by the Wallenberg family. And the Walling family, if you're not familiar with them, is a very well-recognized, reputable, and successful family in Europe, originally from Sweden, who have built up some world-leading companies across many infrastructure sectors. As an example, they have built up Ericsson as the largest shareholder on the communication side, or ABB on mobility, on energy, etc. And they are now into their 5th generation and the largest also shareholder and owner of EQT. And the reason why I mention is that their entire DNA, legacy, and focus on industrial value creation, building successful companies with an operational mindset is very much part of our DNA and our toolbox in terms of developing current infrastructure, in terms of growth, operational excellence, and development. So what we are today is effectively, a team of significant size that are focused on operational infrastructure companies in the geographies and sectors that Seth already mentioned, with a few differentiators. I think the first one is in terms of our sector competence, where we have very deep sector knowledge in our sector teams. So the sectors that were mentioned, the 4 key sectors, we really drive both knowledge, experience, and value creation toolbox for each and every sector, with 20 to 30 individuals in each sector knowing subsector themes, where we will see opportunities arise, where we see differentiated opportunities in terms of downside protected investment with value creation potential. And this sector expertise is something that cuts across all the geographies, and we can take that type of knowledge and that type of experience into some of our core markets. And that's one of the reasons we have, as an example, translated the overall megatrend of digitization of the society to the need of high speed, low latency networks, which eventually has led to significant amount of investments in very successful fiber companies across both Europe and North America. So the sector expertise across these geographies is one key differentiating factor. The second one is how we combine that with our ability to source differentiated opportunities. As mentioned, we're a sizable team, but we're more than 100 investment professionals solely dedicated to this fund. And we're across most of the markets in Europe, we're in North America, and selectively in the developed markets in APAC. And we are living by the ethos of being local with locals. And the reason for that is that we think that, especially for infrastructure, being local in the markets where we look for opportunities and look to invest in infrastructure creates significant differentiation. It creates differentiation in terms of understanding the local market dynamics, differentiation in terms of accessing those opportunities, accessing owners of those businesses, management teams, and also on the value creation side, on regulation, etc. So if you take Europe as an example, where we are clearly have a key focus, we are 50 investment professionals across every single market where we want to invest. And that is truly differentiating, not having just a hub in New York or in London covering all of Europe, but actually being on the ground in Stockholm or in Oslo, Norway, or in Munich, Germany, or in Zurich, or Madrid, etc., in terms of understanding that investment opportunity. And I think that the proof point of this really is what you see on that page, is that almost 2/3 of the opportunities that and companies we have invested in have been outside of these broad auctions where prices are raised significantly and there's a competitive tension. We can actually access them by being local. The third differentiator I just wanted to mention is around our industrial advisor model, and Seth alluded to it already. Our network of industrial advisors, which originally stemmed from the history I mentioned with the Wallenbergs, now consists of 600 what we refer to as industrial advisors. These are C-suite business leaders who have been CEOs, COOs, or similar founders of very successful businesses and operated those over the cycles. And we are working in tandem with them in terms of identifying both investment opportunities, identifying the diligence to focus on, and ultimately going in and using them as independent board directors in the companies where we invest. And that has led to that, they invest their own money and they contribute significantly to the value creation. And this is truly differentiated versus, smaller operating partner type of models. And then the final piece I would mention, before concluding is our institutionalized approach to value creation. And I'll touch on ESG because I understood that was a key topic. So across EQT, we are developing, given the size and breadth of the organization, centers of excellence for value creation, where we can both challenge and support these portfolio companies to achieve the type of investment outcomes we want to achieve. And we've done that across operational excellence, CapEx efficiency, SG&A efficiency. We're doing that on the capital market side on debt. We're putting a significant focus on digitization, but also for certain companies where ESG is a key topic in certain geographies, we're working with them where they can contribute to the value creation potential. So I think that is the summary of the four pillars. I think the outcome of that you've seen obviously in the material, and it was mentioned here as well. We have invested over 5 funds with a net IRR of both realized and unrealized of 18%. And I think the proof is really in the pudding in terms of realization. Half of the investments that have already been done have been realized on an average return of 2.5x, which, and this has been throughout vintages, and we continue to see and do that also in the current environment, with last year being a significant contributor to strong returns. So maybe I pause there in terms of the overview, given the time I was allotted, and then happy to go into any type of Q&A which you would prefer.
So actually, before we take member questions, I'm wondering if you would delve into your ESG policy just a little bit more.
Yeah, I think our ESG policy when it comes to investments in the infrastructure portfolio is a pretty clear one. We are looking at all sides of ESG in terms of value creation as one of the tools in the toolbox on value creation. It is, well, depending on if it's E or C, S or the G, it has different application to different companies and different geographies. But for me and for us, it's a tool in the toolbox for value creation. I heard the word sort of handcuffs. It's not something that sort of limits us in any shape or form in terms of the investments we want to do or can do, but something as a contributor to the value creation. If to give you 2 examples or 1 or 2 examples, if that's helpful, because they're slightly different in how it can manifest itself. One of the recent funds, fund number 5, we've invested in one of the most stable but also opportunity for value creation passenger ferry companies in Norway. This is a business with very long-term contracts, concessions, very limited volume risk, and a significant potential for, number 1, growth, number 2, operational excellence. But we also see that the Norwegian local transport agencies is moving to wanting more electrified ferries along their coast. So, we use ESG and decarbonization of the fleet as a tool in that toolbox for value creation in that specific company where we're moving to electric ferries. In a different case, just to give you a second example, we own a gas compression business in the US called Kodiak Gas Compression. They're one of the top providers, having 1.5 million horsepower of gas compression to the largest players in the industry, including in your state. So in that case, what we are looking to do is to see how will regulation develop in gas compression, and emission limits on certain type of emissions will play a factor. So therefore, the ESG toolbox will come in play and say, how can we create value and be ahead of the competition in the state if we're at the forefront investing in new technology and development of those gas compression units. So, hopefully that gives you a sense of how we view ESG as one of the toolbox together with operational excellence, with digitization and other value creation levers that we pull.
I appreciate the examples. Thank you. I think we're going to hear from member Rawson first. If there are others that have questions or comments, We'll do that after Member Rawson.
Good morning, Stephanie. I don't want to dwell on this long, but my fiduciary responsibility is for the return of the fund and not necessarily for a political agenda. It's been said that the ESG creates value in the eyes of some of the people who have spoken, but you know, value isn't necessarily return. And we're supposed to produce the best results we can for the fund and let the legislature and the governor decide the political agendas. It was mentioned by, I can't pronounce your name, but the gentleman just spoke that it is not, the ESG policy does not limit what we can or what we want to do. Well, it does limit what they can do. It doesn't limit what they want to do, because their policy clearly says that it is it's valued in, or it's evaluated in the sourcing policy, and in the sourcing policy, they eliminate right out the gate. So I would say, yes, it does eliminate what they can do, but I'm just voting against it. I think this is a bigger conversation than we can accomplish here. But in my mind, the ESG does limit the performance that this company or another company could obtain. That's a perspective, and it's a political agenda, and I'm just going to vote no, and I don't think we have to spend a lot of time dwelling on it.
Thank you, Member Rawson. I'm actually going to allow the EQT folks to respond and just talk about, you know, whether or not the returns are impacted by their ESG policy, positively or negatively.
Maybe if I start, and Darlene, if you want to add something, I think just to clarify the terminology, at least when I say it, when I mean value, I actually mean financial return, no other value that I'm referring to. So in those cases where we would focus on this in terms of the value creation, it is because we believe that the financial outcome will be improved as opposed to neutral or negative, obviously. So it's not sort of value at large for society that I refer to. It's the financial return, and you know, hopefully you can see that obviously in our focus has since inception been laser sharp in terms of the financial performance. That's I think part of the reason why we have had the outcome that we've had across the funds. That's why one of the reasons why performance has also improved from fund number 1 to fund number 2 to fund number 3, and also in terms of limits or not. If you know, we can happily go into that in more detail. If you look throughout our portfolio, we have examples where it is you know, clearly not in any way hampering what we can invest in. I think it's a consideration for us, but not a limit in any way. Quite the contrary, we're looking at where we can optimize our financial returns.
And the one thing I would also add is, you know, as you've heard, we're a very thematic investor, investing in our core sectors. And if you look historically, we actually did not invest in the likes of renewables in Fund 1 because, you know, for the very reason we just couldn't get the numbers to work. You know, performance is first and foremost, and as these sectors evolved and opportunity sets changed, we have been able to pursue some interesting opportunities more in that sector of late. But that was a big question because of the, you know, sustainability focus. Why aren't you doing more renewables early on? But it was because, you know, as a fiduciary, they just weren't meeting the return criteria that we've set out for our funds.
Okay, I appreciate that response. And I do see the treasurer and Member Allen both have questions or comments, but before we go to that, I want to make sure that Member Rawson doesn't have anything further.
Well, I would just say when you look at the third point in their ESG policy, which talks about process, it clearly says that they will avoid certain companies. And that is a limitation. Now, that may be a choice that they decide to make, but the decision is based on whether or not the company has an ESG policy. It is not based on whether or not that company can produce value, if he wants to call it value, or return. So the investment decision is based on ESG policy to begin with, and it does limit, if they're going to follow this policy, it does limit what they invest in. So that's clearly now, So those companies are eliminated whether or not they can produce a solid return. That's the only point I'm making, is it does affect investment decisions. And if it doesn't, then why do they have policy? So I'm just not buying the argument. I don't think we want to waste a lot of time here.
Okay, so we've got two other council members at this time who would like to speak. We're going to go to Treasurer Montoya.
Thank you, Madam Chair. On page 137, section 5, value creation ability, it states portfolio companies has been significant with a 12% sales and a 16% EBITDA cumulative average growth rate. Can somebody tell me what that is?
Oh, sorry, EBITDA, that's a performance metric that's very commonly used. It's earnings before interest, taxes, depreciation, and amortization. So it's just used as a financial metric in order to compare. And so we're just showing that there's a consistent and positive growth.
And Madam Chair, in comparison to other benchmarks with other people in your same industry, are you above, at equal, or below your benchmark, and also the percentage of growth or rate of return?
So this is Seth over at Townsend. Maybe I can just address sort of on a, on a performance basis, how we looked at the funds historically, and this is on page 150 of the broader full book. So here we list each EQT infrastructure fund relative to their peer benchmarks, and we do this on a quartile basis. So you can see the quartiles that funds 1 through 3 all on a in the first part of that chart are all looking at it from an IRR basis, from a total return. On the first 3 funds, which are either fully realized or substantially realized, are in top quartile. The newer funds, second and third, as they're still creating value. Frankly, in 2020, it's probably too early to rank those. The other 2 columns within that chart or tables rate the funds again on a quartile basis relative to the value, or the equity multiple, the value paid in capital, and then also dispositions paid in capital. So there's rankings there, but above median on the realized investments, and sort of still in process on the newer funds.
Thank you, Madam Chair. And on page 4, it says EQT, which I found out means equity. EQT has generated a net IRR of 17.8% through the prior 5 funds, placing it at the top of the peer group. Is that correct?
That is correct, over sort of on a combined basis, looking at it as a holistic combination, both from, and then also on EQT's specific returns, but also looking at the universe over those vintage years and strategies.
And Mr. Chairman, Madam Chair, sorry, Commissioner, Madam Chair, as far as ESG is related to our portfolio, what percentage of ESG funds do we have within the portfolio?
Oh, our ESG policy is a great question. I don't know if Steve wants to take that one, if Vince wants to take that one. It's not necessarily a percentage of our portfolio. It's more a guiding policy.
That's right, Madam Chair and Madam Treasurer. We don't have a specific target to ESG related investments. It's more of an overlay on the entire investment program. So as the asset class directors make these investments, they review ESG policies and talk with their potential managers about their ESG policies.
Madam Chair, thank you. So from a Treasury perspective, when we're looking at our policy, when we're looking at all of these different action items that we're trying to approve, we're looking at, are we diversifying the portfolio? Are we mitigating or eliminating risk? And are we able to get a good rate of return with a company that has been able to be adequate? So again, I think it's correct that it shouldn't be political. We should be doing our job to approve these based off of the standards that we've placed on every single other item within this agenda. Thank you. That's all I have.
Well stated. Well stated. Wow. First meeting. Let's go to Member Allen.
Thank you, Madam Chairman. Just a couple of things. The first is I'm actually going to have to get off this call for a half hour at 1 o'clock East Coast time, and then I'll get back on, just so you know. And I vote in favor of all of the proposals that we have in front of us. I don't know if that will count, but just know that's where my vote would be. I just wanted to address what Councilman Rawson said. I don't believe ESG is a political agenda. And I would encourage you to read what's going on in the US with the SEC and in Europe and the UK around ESG. I sit on corporate boards, but also work with a lot of corporate boards around risk management and how they set up the risk committees. And all of them, every single one of them has ESG policies, has a committee that looks at investments and the practices that they have as a business. And it's really good business. It's actually managing risk to have an ESG policy and to follow and to invest and to encourage sustainability. So it's not a political agenda because it's in every country in Europe and the UK, and increasingly in the US. You're going to see metrics that are going to be in disclosure requirements for all corporations in the United States around their ESG policies, and increasingly looking at metrics around that. So for us to invest in investment funds that also are paying attention to ESG is just plain good business for us. It's a good way to manage risks. It's a good way to support sustainability, and it's not a political agenda. That's all I have to say.
Again, well stated. Thank you. Further comments, questions from council members?
Madam Chair, John Bingaman.
Member Bingaman.
Just a question for Mr. Homayun. Just about sort of where do you draw the line between what you think of as infrastructure versus what we sort of would have thought of as traditional private equity? And I ask in particular because of the social infrastructure component. You know, investing in like a chain of radiology clinics, for example, just trying to understand, you know, the infrastructure investing landscape has sort of shifted significantly from its roots in, you know, toll roads and airports and ferries, like you alluded to. Sort of where do you draw the line, or sort of what is the similarity that you see between, you know, some of the healthcare investments and the more traditional infrastructure assets?
Very good question. So I think, you know, a few comments. Number one is where we see, you know, what are the characteristics that we look for in infrastructure investments? These are essential services to society where we're not going to wake up 5 years, 10 years, 20 years from now and have a different need. So these form a very fundamental part of our societies and the service that the societies need to provide. And the reason for that is that gives the downside protection, that gives stability to the investment, which is our, you know, first and foremost objective, you know, safeguarded returns. We're looking for high entry barriers, and that can be largely driven by significant asset-backed companies. But there are some of them which are a combination of asset-backed together with regulation and market positioning. So, you know, there's a combination of infrastructure factors that we're looking for that significant type of infrastructure characteristics. Now, if you look at what we have invested in, and it was referred to up front, the bulk of it is very much in communications infrastructure, transport, logistics, environmental, and these are very asset-backed, energy assets, etc. And social has been really on the smaller side if you look at the entire portfolio. What we have invested in social infrastructure has been typically asset-backed, asset-heavy companies which are providing health and well-being to people on the back of some of the themes we are seeing. As an example, with aging population in Europe, there is just a significant need for certain types of infrastructure, and we see that public spending is not keeping up with the demands that we see, and there is need for private investments in those markets. They are typically regulated, so doesn't attract the private equity type of investments, the subsectors and themes that we would be investing in.
Okay, thank you.
Thank you, Member Bingaman. Anything further from council? All right,
I
hearing
would
none.
love to make a motion.
All right.
Let me make this right. Okay, so based on the recommendation of the Council Investment Committee, Consultant Townsend SIC staff, and General Fiduciary Oversight of RVK, I move that the State Investment Council approve the commitment of the $160 million to EQT infrastructure 6 and $60 million to co-investment vehicles, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Well done, Madam Treasurer, for your first motion. And do we have a second? Okay, we've got a second by Member Allen. So we've got a proper motion by Madam Treasurer, second by Member Allen. Member Lavender got to take a break this time. And do we have discussion on the motion in front of the council? All right, hearing no discussion, we're going to have, and take a roll call vote.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Probst.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
No.
Mr. Messina.
Yes.
Ms. Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-1.
Great. Thank you so much. And thanks to the representatives from EQT for joining us for that very exhaustive presentation and line of questioning that you all represented yourselves well. Yeah.
Thank you.
Okay.
Thank you very much.
Yep. All right. We're going to move now to our two private equity investment recommendations. And the first of those is agenda item 3D. And it's a $60 million investment recommendation into Bain. We're going to hear first from Mr. Cassidy from the SIC. Mr. Cassidy, if you will then just conduct the rest of the presentation, turning it over to Mercer and folks from Bain, if we've got them on the line as well.
Thank you. Just at a high, I'll make some overall high-level comments. For the folks that are just joining the committee, private equity, we think about it in 3 basic buckets: buyouts, growth equity, growth buyouts, and venture capital, which is more early stage investments. We're bringing 2 investments today, one of which is in the buyout side and one of which is on the bucket in the growth equity side. Bain and TA Associates are 2 very important relationships for us on the private equity side. They probably rank as among the highest firms in the whole private equity universe in terms of alignment. There's no outside ownership. Our fees are going to the teams that are investing the capital and creating value. Both firms have very, very high GP commitments relative to the industry. They're putting their own personal capital in addition to ours into every deal. And these are the kind of, when we talk about partnerships, this is what we're talking about. We want to be partnered in deals with them. And we want to know that they're eating their own cooking and that our fees aren't going to people not involved in the process. Starting on the Bain side, this is the second time we're recommending a commitment to a new fund series of theirs. We're invested in their 3 main buyout funds. They have one they can do it geographically. They have one in the US, one in Europe, one in Asia. And we're also invested in a sector specific fund on the growth equity side, where they brought together a very great group of people with a great track record to do a new strategy. And they're doing something similar here on the insurance side. Bain Financials is roughly 7% of the buyout benchmark. And we've been looking for investments in the financial space that are interesting. And this one really stood out. They brought together a very, very interesting team that's done historically some very unique and proprietary transactions, and have been able to create companies at multiples, which are really almost half of what comparable private equity firms are doing. In addition, they've started investing this fund in a couple transactions, both of which are very promising. And they've just put together, as Bain did with the other fund that we supported on the growth equity side, they've just put together a very full team on day one. This is a fully resourced. This is not a typical fund one. This is a team that has a track record, and Bain is throwing its full resources behind the team. So at a high level, I'm quite excited about this. This is a value-oriented strategy that I think has the promise to outperform comparable strategies in private equity. I'll pass it along to Amy Ridge from Mercer to go into a little more detail about the fund.
Great. Thank you, Chris. Good morning to everyone, and a special welcome to the new members of the council. Richard, myself, and Mercer, we're really excited to work with you moving forward. So the first of the two private equity investments we are bringing is Bain Insurance. This is a middle market buyout fund being raised by Bain Capital, and it's going to specifically invest in the insurance sector. Bain is a very large, well-established firm. They're at 650 employees today, 23 offices globally, so great exposure across the globe. And Bain decided to launch this fund based on its strong historical performance in this area and the upcoming market opportunities. The fund's led by 3 partners, all of whom have spent most or all their careers investing in the insurance industry, and they average 25 years investing in this space. The partners are going to be supported by 9 additional investment professionals and then 4 operations professionals, although they also have the ability to leverage the larger Bain organization as well. We like the strategy. It focuses on more complex transactions, which they can do because of that strong operational resources. And those operations people really help to drive the value playbook post-investment. There is also some portfolio visibility. So usually we don't get this. Usually these are more blind pool investments, but they have actually already made 2 investments in the fund, and both are performing well to date. One's already been written up due to strong financial performance. So we are recommending up to a $60 million commitment to Bain Capital Insurance Fund. I will now turn it over to the global head of Bain Capital Insurance, Matt Popoli, for some additional comments. And just for reference, Bain's presentation will begin on page 235 of your materials. So Matt, I will turn it over to you.
Thank you, Amy, and thanks, Chris. And again, appreciate everyone allowing me to be here today. Thank you to all of the investment council members and all of the other participants. So by way of background, my name is Matt Popoli, head of the insurance business at Bain Capital. I have been in the insurance industry my entire career, so have been investing for 25 years only in the insurance industry, and I'm really proud and excited to have been building this business at Bain for the last several years. So we are focused on the $27 trillion insurance industry. So you all may be asking why insurance. It's a really large industry. It's highly fragmented. It's an industry that's been around for a long, long time, providing individuals and companies with all sorts of various protection. And a segment of the universe that we focus on has been around for 120 years. And so for you history buffs, I mean, there are a lot of companies that have been around since the 1800s. And again, we're usually, when we make our investments, really the first institutional capital into these businesses. So if you think of a company that's been around for 120 years and we're the first real institutional capital that gets to come in, help the management team, help the boards grow the business, it's really allowed us to do some really exciting things in insurance. And you won't hear people say exciting in insurance in the same sentence very often, but you will definitely hear me say that. Shifting a little bit to our team is as Amy mentioned, and Chris did as well. You know, we've built out what we believe is one of the largest dedicated teams in the insurance private equity world. So consistent with the other sector focused strategies that Bain has launched, we built the entire team, you know, before we raised $1 of outside capital, and that really allowed us to get all the resources that we need to deploy the fund in a way that we're going to, and consistent with the deals that we've done over time. I think one of the interesting aspects of the industry is it is not necessarily correlated to a lot of other industries. And so if you look at the way that we approach our strategy, we're very focused on entry value. We've been very disciplined and have been able to acquire businesses at what we think are very meaningful discounts to the market. And that really creates real downside protection in our strategy, and also creates the opportunity for us to generate really attractive returns. Historically, we've generated north of 20% gross returns in the strategy, which dates back more than 15 years. And in the fund, we're targeting a similar level of 20% plus returns. We are targeting to raise $1 billion of outside capital. And as was noted, the employees of the firm are going to be a significant investor as well. We've already committed over $100 million to the strategy, so we'll be a meaningful percentage of the fund. Again, I think really aligned interests. People have already done a lot of work on this, and so I'll keep my remarks brief. And so happy to answer any additional questions from any members of the council. And again, appreciate all the work that's been done to date by everybody. Thank you.
Great. Thank you, sir.
Thank you.
Okay, so we're going to hear now from council members who have questions for either our staff, Mercer, or Mr. Popley. Hearing no questions, do we have a motion?
Madam Chair, based on the recommendation of the Council Investment Committee, Consultant Mercer, SIC staff, and general fiduciary oversight of RVK, I move the State Investment Council approve a commitment of up to $60 million to Bain Capital Insurance Fund LP, subject to and contingent upon the Mexico legal requirements, the Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Thank you, Member Lavender. That's a proper motion. Do we have a second?
Okay, I just want to make sure
I'll second.
Member Messina. Great. So we've got a motion by Member Lavender, second by Member Messina. Any discussion on the motion? Okay, just as a reminder, this is a proposal for a $60 million investment into Bain Capital Insurance Fund. And if we could have Andy take a roll call vote on that motion.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Props.
Yes.
Mr. Lavender.
Yes.
Mr. Rosson.
Yes.
Mr. Messina.
Yes.
Miss Allen. She's gone. Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-0.
Great. Thank you so much. And thank you to Mr. Popley for being on with us.
Thank you, everybody. We appreciate your support.
All right. So for our last investment item, and I need to read this because it's a little bit complicated. This is going to be a total of a $300 million investment into TA. It's a $225 million investment and then a $75 million follow-on, I believe. So we're going to turn it back over to our same team, Mr. Cassidy, Mercer, and representatives from TA.
Thank you. So TA is another very important relationship for us. They've performed fantastically for the SIC. and they kind of tick all the boxes you want in a private equity firm. We're recommending 300 million in total. They have a $225 million flagship fund, which is a very broadly diversified fund with over 50 investments across 5 sectors and across all the major geographies in the world. And a 75 million select opportunity funds that will selectively reinvest in some of the companies from the flagship funds where they want to hold on to those investments for a longer period of time. Kind of the winners, holding on to the winners, basically. 300 million is the largest commitment we have made in the program. By way of comparison, though, just the way I think about it, you look at what we've done with Bain, where we're now invested in 5 fund series of roughly 50 to 60 million each commitment. This is roughly comparable to that. It just happens to be 2 funds rather than 5 separate funds. The larger than average commitment reflects really kind of 4 things. If you haven't noticed, we have been receiving a lot of inflows, so our pacing is going up. We have a very high conviction, both staff and Mercer and TA as an institution, and it's an investment strategy. The funds are very diversified. And fourth, and this is a kind of a unique one, and frankly, we wish we saw it a little more in the industry. The firm has an incredibly disciplined approach to liquidity. If I had a criticism about private equity over the last year, is a lot of groups did not use the opportunity of last year or in 2021, excuse me, to monetize investments probably as much as they should have. And TA's incentive structure is set up to, really push people to realize returns on their investments rather than hold them indefinitely. And it's really put them on the front foot relative to their competitors. There's few firms that achieved as much liquidity in 2021, and the folks at TA can talk a bit about that later. And then the Select Opportunities Fund is also quite unique. I'll let Richard talk about that, but the way they've done the management fees and the way they've set that up is really thoughtful, which is why we're comfortable with up to a 75 million commitment. I'll pass it along to Richard, who loves talking about TA.
Thanks, Chris. Yeah, TA is a re-up for the national program. As Chris mentioned, it is a strong performing relationship for the SIC. In total, TA's generated a net IRR of 24% and a net multiple of 1.9 times for the national program as of June 30th, 2022. And in particular, TA12 and TA13 have been 2 of the strongest performing funds in the portfolio from an IRR perspective, generating net IRRs of 39% and 45% respectively as of June 30th, 2022. And we continue to like TA and support it as a manager in the national program. TA has a large senior leadership team who averages 18 years at the firm. They've found a way to be proactive at succession. They've been around for a long time and really have an efficient way of transitioning senior leaders over a long period of time so they can still capture that expertise. From a terms perspective, TA has a large commitment to the fund alongside limited partners, and even with the larger fund, which we like to see. From a strategy perspective, TA has always been strong in sourcing and continues to be very active in proactively seeking investments. This is an area where TA's really set the market standard, and you see a number of other private equity firms seeking to follow a similar approach. But they've also continued to evolve and improve resources over time. So over the more than 15 years that I've tracked TA, I've seen them add more operating resources and capital market resources, which has really added value to portfolio companies. And we like that they are constantly seeking ways to improve. They have a strong track record overall, particularly in funds since 2010. And they've had strong realized performance over the last few years as well, which speaks to the quality of the companies. Just to mention quickly about TA Select Opportunities strategy, the SIC did commit to the last 2 funds, 58 million to the first fund in 2019 and 40 million to the second fund. This strategy takes minority positions in existing TA portfolio companies, as the main fund will partially or fully exit the companies. And these are companies where TA has re-underwritten the investment. The same TA team that manages the fund manages this strategy as well. The TA team has also made a large commitment to this fund, so it has good alignment between investment team and limited partners. And the terms are also favorable for limited partners, so it's an efficient way to gain more exposure to TA investments for investors. So we're recommending a $225 million commitment to TA 15 and a $75 million commitment to TA Select Ops 3, so a total of $300 million to TA. And we have in the meeting today Ajit Nedungande, who's been with TA since 1999 and has been CEO since 2021. And he's joined by Andrew Harris, who's Director of Investor Relations for TA. We'll turn it over to them and happy to answer any questions following their presentation.
Thank you very much, Richard, and thank you, Chris, and more importantly, thank you to everybody on the State Investment Council for the support you've provided us over the years. We try to be sensible fiduciaries of capital, and we appreciate all the support we get from our investors. So my name is Ajit Nedungade. I've been at the firm 23 years. I joined in Boston as part of our technology group, and then I came to Europe to start a European business 20 years ago. And over the last 10 years or so, I've evolved more into a firm leadership role, driving our underwriting strategy, and as chair of the investment committee over the last several years. A few things about TA that I'd flag, and I'll try to keep this brief. One, we're a global firm, but we're a single business and a single team on a global basis. We've got 6 offices around the world, 3 in the US, East Coast, West Coast, and Texas. We've got a London office, Hong Kong office, and a Mumbai office. We're primarily a US, North American, and Western Europe investment firm. About 10% of what we do will be out of the Asian offices in Mumbai and Hong Kong. I think it's very important to just note that we are a single business. We're a single partnership. We own the firm. The partners of the firm own 100% of the firm. In that sense, it's a fairly traditional partnership. The average partner has been in the firm for 18 years. In the last 30 years, no partner has left other than to retire. No one leaves to go start a competitive firm. No one leaves to join a competitive firm. And we're the biggest LPs in our funds. We have an 8% co-investment commitment into our fund, and we'll do so on 15 and Select Ops 3. The sort of continuity and the single line of business aspect of how we do our business, we think is very important to the long-term record of the firm. The other critical aspect of the firm is our culture. We have sort of 3 core tenets to our culture that we spend a lot of time investing in and ensuring. One is our meritocratic incentive system. We have a system by which ownership in the funds follows performance in a highly identified and understood way by the partnership. So we attribute returns and performance down to individuals in a very specific way, which then allows us to have ownership in the funds follow performance in a very transparent manner. I'm the CEO of the firm. I'm not the biggest owner of the firm. No one of the firm, and because ownership follows performance, there are others that have the top performers own the top amount of a carry in the funds. So this idea of attributed performance driving ownership is a very important part of our culture. The second important part of our culture is entrepreneurial, kind of the entrepreneurial spirit by which we go about the market. So Richard mentioned our outbound origination efforts and the way by which we go about seeking opportunities in our 5 verticals. That is done in a very systematic industrial scale manner. We're visiting 3,000 odd companies a year across the world. We're calling into thousands of companies a year in order to identify and close 25 to 30 investments in a year. When an individual joins the firm, 90% of our partners started at the beginning of their career at the firm. So typically start as an associate or as a VP after business school. They then spend their entire careers inside a specific industry vertical, becoming experts in that vertical, and thereby spending all of their time identifying interesting opportunities through this very proactive, outbound, sort of go out and make things happen culture inside the firm, which is very important. The third aspect of our culture, which we think is critical driving our long-term performance, is the discipline of our underwriting processes and the discipline of our processes in general. Having been around a long time, we've been through, as Richard mentioned, multiple generational transitions. We think that having a process, a well-established, repeatable process by which you make individuals partners, by which partners retire, by which you do leadership transitions, and very importantly, by which you do underwriting decisions, is very important to the long-term sustainability of the firm and outperformance of the firm. On the underwriting process, it is a very unique process by which we actually, the individual IC members spend an enormous amount of time with the underlying asset that they're underwriting in a way that's atypical for our industry. And we actually have this process by which we write opinion papers, which we share across the firm in a very transparent manner, such that each investment committee member articulates their view of an investment to the entire firm and shares it with the firm in a way that's, I'm not aware of any other firm that does it quite that way. I'd say a couple of other things that are critical. Our strategy is what we call growth HQBM investing, which is focusing on growth as the driver of value, and that the target companies we go after are those with the best quality business models that we can identify. We've spent a lot of time thinking about quality of underlying business model, the resilience, the durability of the model, the ability to raise prices, the ability to cross-sell, the ability to upsell, the ability to expand the product set that's sold to the customer base within our specific verticals: software, financial services, payments, healthcare, consumer and business services. Within each of those verticals, we identify areas and sub areas into which we believe there's an opportunity to grow the footprint of the company that we're looking at. And we spend a lot of time on that. A key vector of value creation for us has been our industrial scale M&A program. So we do a lot of buy and build, very successfully so. Last year we made about 250 acquisitions into our portfolio. And that is a very systematic process of identifying interesting targets using our outbound origination strategy to identify targets, not just for ourselves, for platform companies, but also for our portfolio companies to acquire. So we are very acquisitive, and that has been a key driver of an important driver of returns for us over the last few years. And then finally, liquidity, which Richard mentioned, is built into our meritocratic system very intentionally. We reward for realized gains, and ownership in the funds follows based on realized gains that a partner generates relative to their other partner. So the numerator is an individual's realized gains, the denominator is the sum total of all the other individuals' realized gains. And that drives a process by which liquidity is generated structurally in our incentive system. And we're increasingly big believers in partial liquidity rather than a binary hold or sell, in partial liquidity as a way by which to manage risk, while at the same time participating in the long-term performance of the underlying portfolio. And so you could see our performance where our IRR performance has been very good, but we're particularly proud of the DPI and the TVPI performance of the funds over this period of time, driven by this liquidity approach. Probably pause there and take any questions if on any subject that folks would like.
Great. Thank you, Mr. Nandugati. And we've got a question from Madam Treasurer.
Thank you, Madam Chair. On page 296, the portfolio limitations, can you go over that a little bit for us?
Bear with me, 296.
Particularly the section that says no more than 15% of commitments in a single portfolio company in public securities, in recycling of capital, in bridge loans or outside the US and European Union, excepting certain developed nations. If you could go into that one specifically for me, just so I could better understand.
This is a question that relates to a page in Mercer's memo regarding fund terms.
Okay.
So I don't know if Richard or if you want to talk about that or.
Well, it looks like Mr. Nandugati wants to answer, and then maybe if Richard wants
we've got
to provide
limits on context. The maximum amount we'll invest into a given investment, and we have limits on what we will invest outside of North America and Western Europe. I don't know if that's what you're referring to, but we do have we put limits on that as a way by which of managing our overall portfolio construction and portfolio profile, which is, I think, the numbers that you're referring to.
Yes, go ahead.
Yeah, and just to further elaborate, one of the reasons we have portfolio limitations in there, even though private equity managers tend to have broad mandates of where they can invest, We like to see guardrails on what they can and can't do related to their strategy. You know, for example, with TA, you don't want them to start investing in venture capital where they don't have as much experience previously, for example. So these are portfolio limitations that are in the limited partnership agreement that, you know, it prevents them from, you know, putting all the capital in one company, for example, as they're limited to putting no more than 15% of commitments in a single portfolio company.
Madam Chair, thank you for that response. This page actually made me feel a lot better about the increase in what you're wanting to do in comparison to what you've usually done in the past. So I do appreciate that. Thank you.
Thank you, Madam Treasurer. Further questions from council? Hearing none, do we have a motion?
You know, you hear my voice a lot, Laura. You want to take this one again?
You're such the expert, though.
Well, you know, I can go ahead and do it. It's just a lot of words. That's okay. We'll play. We'll trade off. This is based on the recommendations of the Council Investment Committee. Consultant Mercer, SIC staff, and general fiduciary oversight of RBK. I move that the State Investment Council approve a commitment of $225 million to TA 15-ALP and up to $75 million to TA Select Opportunities 3-ALP, subject to and contingent upon New Mexico legal requirements, New Mexico State Council Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Okay, that's a proper motion. Do we have a second?
I'll second it.
All right. We've got a motion by Member Lavender, a second by Madam Treasurer. And once again, this is a total of a $300 million commitment, 225 into TA 15, and then the additional 75 into TA Select Opportunities 3. Could we have Andy take a roll call vote on this motion, please?
Commissioner Garcia Richard,
Yes.
Treasurer Montoya,
Yes.
Secretary Props,
Yes.
Mr. Lavender,
Yes.
Mr. Rostam,
Yes.
Mr. Messina,
Yes.
Ms. Allen, Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-0.
Thank you, Andy, and thanks to the folks from TA for being on with us today. Very good. Okay. That concludes our investment votes, but we do have a couple of additional votes. So the next one being agenda item 3F, renewal of our contract with Mercer. And Mr. Cassidy, are you taking the lead on this?
Yes. So we have a very long standing relationship with the team that's now at Mercer. Actually, the predecessor firm was called Pavilion, which merged into Mercer the last time we extended the contract. So now it's Mercer. I think we have the best consulting to have. I think incredibly highly of them. They perform 3 roles for us. They advise us on the National Private Equity Program, the New Mexico program, and they also help Keith Sable with some of the investments in the real return portfolio, really energy related private equity investments. You know, not only has performance been good, you know, they took over the portfolio in 2011. You know, the net IRR of the national programs over 18%. And when they took over the program, obviously there was some history there prior to that. They've really done an amazing job. I mean, this portfolio started from nothing. They effectively started from scratch. And as you know, as time's passed, our access to great managers has increased. They do very thorough due diligence work. They re-underwrite every investment as if it's new. There's no shortcuts. There's no taking the easy route to do a re-up where, you know, it'd be convenient just to do the re-up. We re-underwrite every investment every time, which I really appreciate. And they work hard for us. They want us to succeed as an institution. And again, I think we have the best team. They're willing to continue on the exact same terms as last time, which frankly I think is quite a good deal, because you see the amount of work that's going into this portfolio right now. The pacing is doubling, tripling. It's a lot of work. Some of the funds we're getting access to, or we're maybe they only have 1 or 2 clients that are getting access to them. And so some of this work sometimes is only for us. Like the Frontier Fund is an example of that, where hundreds of hours of work went into that between staff and so can't say good enough things, as you can tell. And we're recommending an extension for another 4 years from till March 2027. And this would be the third extension of the contract.
Madam Chair, this is Keith Sable. I would like to just add my voice in support of this recommendation from Chris. Mercer's been doing just fabulous work for me on the real asset side. It's very much appreciated, and I don't think we could have a better team.
Great. Do we have questions from council on the vote to renew this contract? Yes, Madam Treasurer.
Madam Chair, only because I'm new, you said this is the same cost that you already had in the previous contract. Is that correct?
Correct.
And I don't know what the rules are for you all, but I know for a procurement process for us, we have 4-year contracts, and for fiduciaries or portfolio managers, we can only do up to 6 years. Does any of that extend to SIC, or does that matter? I see they've already been in for 12.
Leave it to Evan Land, our General Counsel.
Hello, Madam Treasurer. The answer to your question is no, we are not restricted in that matter. Yes, we are perfectly compliant with statute. The SIC has a procurement exemption for investment managers, for investment advisors, and all investment related activities. Obviously, Mercer kicks several of those boxes. They're not a manager, but they're everything else. And that is at 13.198C of the procurement code, or NMSA. It's actually within the procurement code. So the fact that we bring it every 4 years is just to give the council increased oversight and to have prudent reviews of those managers. But as a contracting, regulatory, legal matter, it's eminently appropriate and done correctly.
Thank you, Madam Chair. And it is in your current fiscal year budget request as well, correct? I think I saw it.
It is.
That's all the questions I have, and I appreciate the work that they did today to help me get through this, as well as Townsend. Thank you.
Awesome. Any further questions from council? Do we have a motion before the council?
Madam Chair, based on the recommendation of the Council Investment Committee and the SIC staff, I move the State Investment Council approve the renewal of the investment advisory contract with consultant Mercer as set forth in the meeting materials and discussed by the council today.
I will second that motion.
Okay, we've got a proper motion by Member Lavender, second by Madam Treasurer. Do we have any discussion on the motion before council? Hearing none, we'll have Andy take a roll call vote to renew the contract with Mercer.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Probst.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Ms. Allen, has she rejoined us? Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-0.
Very good. Okay, next we're going to go to agenda item 3G. We're going to hear from Mr. Lofton on a vote for a hedge fund exposure recommendation. Mr. Lofton.
Right. Thank you, Madam Chair. This is item 3G. I believe it's on page 397 of your in your materials, and it is titled Recommendation to Further Reduce Exposure to Hedge Fund Structures Within the Non-Core Fixed Income Portfolio. Per the current adopted fixed income structure study that was approved back in January of 2020, which over I believe 500 million in legacy hedge fund redemptions were noted at that time. Staff in consultation with consultant Nikita and broadly consistent with our current fixed income structure study, recommends further reducing exposure to hedge fund structures within the non-core fixed income portfolio as listed in your memo. Funds from these strategies are to be exited or expected to remain funds from these strategies to be exited are expected to remain within the non-core fixed income portfolio and reinvested due to restrictions on liquidation distributions unique to each exited fund. Staff projects the distributions are going to be available periodically, likely quarterly, over the next 12 to 36 months. And with that said, are there any questions?
Questions from council?
Yeah, I have a question.
Member Ross.
I'm sorry, I don't quite understand why.
Oh, sorry, Member Messina.
Yes, thank you, Madam Chair. I don't understand why you're making this recommendation. If you could clarify that a little for me, please.
Sure, it's a good question, Member Messina. You know, there are a range of reasons why we think we should continue exiting these types of structures, but I would probably boil it down to three primary reasons. One is economics, and that's why I use the wording hedge fund structures. So hedge fund structures, they're in a broader sense, I would say they're generally inefficient relative to other private credit fund structures that we have available to us. And just broadly, I would say the annual crystallization of fees, for instance, many of our term funds have a hurdle rate. So there are management fees, but there's an incentive return, whereas the GP or the manager, their ability to participate in the economics and gain additional fees they're dependent on them reaching a certain hurdle rate return for the investor, and the timing of those fee outflows are therefore a little more back-ended. With a hedge fund and what we call the annual crystallization, where the fees are charged based on the market valuation of the fund on an ongoing basis. Frankly, that puts more, I would say, not that any of our, not that we don't trust any of these managers, I won't imply that, but it does put more pressure on the quote unquote market valuation process. So, there's certainly some economics there. And then I would say, and we're going to expand on this more so next month when we present the fixed income structure study, really the role of fixed income within a multi-asset portfolio. When paired with equity investments, fixed income is generally the role is generally to provide a level of cash reduction, or cash production, and yield to be spent or really reinvested through an economic cycle. Secondly, to offset equity volatility, and frankly, hedge fund trading and shorting strategies tend to obfuscate that role. And then finally, I would say, frankly, the efficiency or the efficacy of consistently executing shorting strategies through a cycle and through various market environments, the efficiency of that process is frankly suspect. So I would say those are the three primary reasons. There are some other nuanced reasons that we can get into, but those are probably the primary reasons that we want to move away from hedge fund strategies.
Madam Chair?
Mr. Lofton, before we move on, Mr. Lofton, can you tell us what page number this recommendation falls on in our packet?
Yeah, 397.
Madam Chair, it's Vince. Can I make one comment?
Absolutely.
Tom's reasons that he went through were some of the things that we thought through to bring the recommendation. We've got significant flexibility within our rebalancing policy to reduce or increase specific investments. But if our intention is to eliminate it, that's when we bring it to you for approval. And that's our intention, is to eliminate these funds.
Thank you
Member
both. Thank you very much. Appreciate that.
Anything further from council on this recommendation?
Madam Chair, that was exactly my question. If you have the flexibility within your policy, why would we have to do this? But it's that they want to completely eliminate the hedge funds from being invested in this portfolio. Is that correct?
Vince?
That's right.
And the three, Madam Chair, and the three reasons were economics, fees, and what was the third one?
Mr. Lofton?
Really, the efficiency of hedge fund strategies.
And Madam Chair, how much do you currently have in hedge funds in your portfolio?
You know, as of June 30th, I think we're sitting on around $1.5 billion NAV.
And Madam Chair, what do you plan to do with that 1.5 billion that you already have invested in hedge funds?
Madam Chair, that'll go just right into our rebalancing policy and cash levels in the funds that held those units.
Madam Chair, I think since this is not something that is as urgent, I think I want to learn more about it in this next month, and I will probably not vote on this. I need to learn a little bit more before I do.
Fair enough.
Madam Chair?
Yes, Member Messina.
Yeah, considering the treasurer's point of view, should we table this till the next meeting, or does that matter?
Let's hear from staff on whether or not it's an urgent item.
I don't think it's urgent.
I agree.
Certainly,
It's not.
So do we have a motion to table this agenda item?
So moved.
Madam Chair, I so move. If that's all right, may I make the motion?
Okay. So the treasurer made the motion. Maybe you could second it, Member Messina.
Yeah, I'll second it.
Okay, so we're going to take a roll call vote on a tabling motion.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes, please.
Secretary Props.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 7-0.
And
Member Allen is actually back with us, Andy.
Yeah. And I vote yes.
Member Allen.
Yes.
Motion carries 8-0.
So in the meantime, could we request a briefing to the treasurer and whoever else on the council wants it, just to dive deeper into this recommendation, Vince?
Sure, Madam Chair, you bet. We'll get with everyone and set up a Zoom and talk it through to everyone's satisfaction.
Perfect. All right, with that, we're going to move on to agenda item 3H and hear from Mr. Smith on the recommendation to temporarily suspend the limits for fixed income allocations. And if you could please give us a definition of what temporary means and page numbers.
Okay, I can do that. On the very next page, it's 398 in your packet is a memo from me. I need to make a couple of corrections to this thing, and I inadvertently submitted my draft to the book building process instead of my final. So I got a couple corrections on this. The first is the third page of it, which is on page 400 of your packet. That's irrelevant to the recommendation. It's just a table from a previous recommendation I was using to build the table on the first page. So, and it is still there in the draft. The second is some updates to the numbers in the table on the first page, or page 398. So in the middle column there, it says policy limit. For land grant, that number should not be 12, it should be 14%. The number for severance tax that says 14 should be 16. And the water trust, where it says 10, should be 12. Back in November of 2021, we came to the council as inflows started to really increase, and requested a limit lift on those three funds to be able to deal with the inflows that were coming into them. And I just didn't get that incorporated in the memo. It makes a little bit of a difference on the excess bonds plus cash. It reduces it from 5.3 billion, which is what's in that column, to about 4.6 billion. So there's a small decrease to the total bonds and cash because of those higher limits. So those are the corrections on there, and I'll get you a clean memo for the record in terms of this doc. So just as some background, the contributions to the permanent funds in 2022 were just fantastic, 8.1 billion. We told you at the top of the meeting, and it's in this memo too. 2.7 from the land office into the land grant permanent fund. 3.2 came to the early childhood, and severance tax received another 1.7. So just amazing inflows. But it's led to this issue of excess bonds and cash. So when we have excess cash in the portfolio, it's our first place to put it in our asset allocations is our core bond portfolio, and for some of the reasons that Tom was talking about. So NAVs tend to be stable in the core bonds portfolio. We tend to get a little more income than we do from cash markets, but it still remains very liquid for us to use when we get capital calls or need to rebalance the portfolio. But what's happened is the inflows have been so great that to be able to do that, to be able to hold it in the core bonds portfolio, we would have to exceed the upper limits of policy. Now it's a little bit different for each fund. So it's difficult to just name a number and say, well, let's go to 16% on land grant, or 14% on water trust. We might blow right through those. Inflows have been that good, and potentially in this next year we see even more, or continuation of these high flows. So my suggestion to you is to suspend these limits, and by suspending them for 6 months, and by suspending them, it just means we don't have a limit, a precise limit on these. Now, I was asking in the investment committee, well, how much do you think it would go over? Give us a ballpark on that. I told them 3%. That was more around land grant, and that's probably toward the low side. But some of these other funds that are smaller and get these huge inflows, it would be in excess of 3% over the current limit, potentially anyway. But again, it's core bonds. It's our second safest asset class in terms of net asset value, stability behind cash. So it's a very safe asset class to be over limits. And another solution to this is to use all of our publicly traded markets to put this excess cash in. That would include the equity markets. But as we've discussed, we're still headed for a recession. Earnings estimates for the S&P 500 have hardly come down at all. We think those go a good bit lower if we do move into recession, which means lower prices in the equity markets. We just don't think that's a stable place to hold this money, and we're certainly not in an uptrend here in markets where potentially we could make some capital gain. The returns are quite skewed to the downside on relative probability. So So we really would like to keep it, be able to keep it in the bond markets, as well as hold some cash. Generally, in a situation like this, when we do get some excess capital like this, I tend to hold it in a 30-70 bonds cash up to a 70-30 bonds cash. So we're never 100%, never, or is the overage 100% cash nor 100% bonds, but a mix of the two. So the suggestion or the recommendation to you is just to lift these limits for 6 months. Certainly, we'll give you updates every month when we meet as to where we are, and in 6 months review if we need to continue or if we can fall back to our policy limits. So that's the recommendation for you.
Okay. Thank you, Vince. We have a question from Madam Treasurer.
Madam Chair, how much over are you in regard to the IP, the investment policy?
Madam Treasurer, that's in the memo. So if you look at the excess bonds and cash line, that, well, actually, if you look at the current allocation column, compare that to the policy limit column and do the math there, and you can see for each fund how much we're over.
I'm assuming with the correction that you made on the policy limit, for example, on the land grant, you're saying 15.7 minus 14 instead of 12, correct?
Exactly. That's right.
I think what my bigger question is, well, two things came to mind during your presentation is one, is there another solution? And two, the money that's coming in from that 1.5%, that was the constitutional amendment, which is the growth from the those two funds, you're going to be receiving that every year, isn't that correct?
The contribution from the land office, is that you're referring to that one?
Yes.
Right. Yeah. So this year we had a big excess over history. So historically, at least over the last 10 years, we've received $40 to $80 million a month from the land office. As Steve talked about earlier, it was close to 300 million last month, and it was over 300 million the month before that. So the excess that we're currently receiving is way over historical. So we would expect it to come at some point to start reverting to the longer term mean, and this suspension wouldn't be necessary.
And just a reminder, Madam Treasurer, that the constitutional amendment impacts the distributions from the fund, not the inflows. So this recommendation of temporarily suspending the limits is around just having too much cash inflow too quickly. Yep. And so she asked about an alternate, and you did mention, Vince, that we could open it up to all of our allocations and talk about that again and why that's an issue, or what.
I think
did you want to hear about
risk?
Yeah. Okay. So that was another option.
Third solution.
Is there a third option on the table?
Yes, there is. That would be to hold the policy limits where they are and just put the additional that we can't get into the bond market, just hold that in cash. I think we likely give up return if we do that. The bonds yield higher than our cash does. And as we slide into recession, we very much expect to see bond yields to come down, which means price increases to the bonds that we hold. So I think we would have a strong probability of giving up some return if we can't hold the amount of bonds we want to hold.
Madam Chair, I agree. And is there a possibility to put any of it in the LGIP? Would that be helpful to you all?
Potentially, our cash is now managed by our custodian, JP Morgan. It's an all treasury portfolio, quite safe, but potentially.
That could be another option that we could definitely work with you on as well. Thank you.
Madam Chair, if I could just interject a little bit, this is an example. We spent a fair amount of time at the investment committee talking about what the impact of this is, and this is back alluding to my earlier comment about this being a blessing, all these inflows. And what this is an effort to give the staff, at their best recommendation, give them the freedom to try to make us as much money as possible. So again, it's a temporary thing. I think the fact that we're going to be brought up to speed every month on how it stands is really important. And I recommend we move ahead with this and give the staff the freedom they need to manage this. But with the idea that certainly open to other possible ways to do it, which I think would come back to us again. So that would be the idea. If you'd like me to, Madam Chair, I'll put this in motion.
Well, we've got, I think Member Bingaman might have had something. He unmuted himself.
Yeah. Okay. Sorry.
Thanks, Madam Chair. Yeah, just real briefly, and I'm supportive of more flexibility as well, but just wanted to ask Vince your comments about the public equity markets. And I noticed we're currently kind of below target in terms of international equities. So is your thought that we're effectively going to sort of tactically be underweight for some portion of this year, public equities as we're getting these inflows, or are you envisioning that we're going to stay at that more or less 20% to US and 20% to international as this money comes in?
Yeah, Member Bingaman. So our current strategy really is to stay fairly well snugged up to our long-term targets in equities. We don't have any intention of holding higher than our targets, and so the targets are 20 and 20, as you mentioned. We are a little bit under, on the November report, because we had a couple of months there that really dropped down, and usually that pulls those weights down. I think we will have an investment in the international equities this month. We've kind of penciled that in for the rebalancing, so we'll be closer on international equity. But you should expect to see us, 18, 19, 20% on both sides.
Okay, thanks.
There's no certainty the market goes down from here, right? I mean, the economy can turn around, markets can take off. So being underweight those targets, we don't think is the best move, but certainly being overweight is not.
Understood. Thank you.
Anything further from council? Okay, we have Member Lavender with a motion.
All righty. Based on the recommendation of the Council Investment Committee and SIC staff, I move that the State Investment Council approve the temporary suspension of limits for fixed income as set forth in the meeting materials and discussed by the council today.
Second.
Okay, we've got a proper motion by Member Lavender. I believe a second by Member Probst, Secretary Probst.
That's correct, Madam Chair. I'm trying to catch up with Treasurer Montoya.
All right. Is there discussion on the motion before the council? Hearing no discussion, we're going to have Andy take a roll call vote on a vote to temporarily suspend the limits for fixed income allocations.
Commissioner Garcia Richard.
Yes.
Treasurer Montoya.
Yes.
Secretary Probst.
Yes.
Mr. Lavender.
Yes.
Mr. Rawson.
Yes.
Mr. Messina.
Yes.
Miss Allen.
Yes.
Mr. Bingaman.
Yes.
Madam Chair, the motion carries 8-0.
Great, and great discussion. Let's move on to agenda item 3I, a discussion of management fees and relative costs from Mr. Smith.
Thank you, Madam Chair. We've got RVK in the room, and so I want to pass over to them if they have any comments about their memo, and certainly if you have questions on it, they're the authors, so they're the ones to address those. But I did want to make one comment about it, and it's on page 2.
Page number?
402 in your book, page 2 of the memo, 402 in your book, and it's the second paragraph. Anytime we talk about fees, and we get asked a lot by the legislature, but anytime we talk about fees, we always insist that we also talk about performance. Those two things are joined at the hip, and so even in an environment where our fees were higher than our peers, we consider that in the context of our returns. So the second paragraph of page 2 of your memo here, page 402 in your book, outlines that performance as of September 22nd of last year. Our 1 year ranked in the 8th percentile. These databases tend to have between 70 and 80 funds in them when they rank your percentile. So So out of a database of 75 or 80 funds, the 8th percentile means maybe 2, maybe 3 funds beat us in that 1 year period in the country. You can see our ranks for 3 and 5 years are nearly in the top quartile, 29th and 28th percentiles. And for our 10-year period, we were nearly in the top third. So when you consider fees, consider also those performances relative, certainly relative to our peers. But in this case, we stack up quite well in this analysis, and RBK can address the details. But you can see our fees, for the longer time periods, 3, 5, and 10 years, are in the best or in the best quartile, the top quartile, lowest quartile in terms of fees, but top quartile in terms of favorable fees. So we got a combination here of some of the best investment performance over long time frames in the country, matched up with some of the lowest fees across our peers. So with that, let me turn it over to RBK if they want to make a point or two, and then certainly field any questions that you have.
I think Vince covered it very well. I would just add that really we set out to determine are the fees that the SIC pays specifically for management fees across the investment manager roster, are they reasonable relative to substantially similar peers? And so this peer group that you see here is a peer group of other funds with at least $1 billion in assets. So similar size, similar scale, the intention there being, do they have the same type of access, staff, and ability to negotiate similar fee terms? But then also importantly, do they have similar investment objectives and asset allocations? Because the asset allocation is always going to be the primary driver of both investment results as well as the fees that are paid. So this is I think it's a highly relevant peer group. It's one where you see that the SIC is ranking favorably in terms of certainly being above median, which is where we'd like to see it, and being in the top quartile across some time periods is a nice added benefit. We always have to put the fees into context, exactly as Vince mentioned. What are you actually getting for the fees that are being paid? And you're certainly getting very strong performance for the fee dollars that you're expending. So you're being highly efficient with the fee dollars that you're paying out in that regard. So happy to take any questions or comments on this analysis. And again, any analysis like this, I would just caution that it's an imperfect exercise, but we made a best effort to really make it as relevant and applicable as possible.
Okay.
Madam Chair, is that 53 basis points for the total amount of the portfolio that they manage? Is that what I'm reading?
It's for the SIC. Yeah, and it's investment management fees only. During the CIC, there was a question, does it include consulting fees across your various consultants? And the answer is no, but you'd probably be pleased to know it really is a rounding error if you were to add the consultant fees in there. So it doesn't really change the numbers. It doesn't include carried interest, which is obviously highly variable and differentiated between funds. So it makes the analysis a little bit more convoluted, but on a actual management fee basis in terms of what you're paying year after year, this is highly applicable and relevant.
And usually the carried interest is lined out in the terms of each recommendation, right?
And that information is available. I think Brent tracks it in the spreadsheet that we were using to help establish certainly the SIC fees and double check our work has that information. But we certainly don't have that level of look through for the peer funds, which makes that exercise more challenging.
Madam Chair, I think in the context of this report, it just assumes that the carry portion of our fees relative to these peers is the same because they don't have to look through to verify it.
Thank you. Anything further? All right. We thank you for that perennial discussion of our management fees. All right, so with that, we'll move on to agenda item 4. We're going to hear from our Chief Financial Officer, Mr. Ship.
Madam Chair, I'll be as brief as I can. I think I'm going to hit on maybe half a dozen slides. Certainly, if you have questions on any of the others, I'm happy to take those. I'm on page 404 of the material, and I will be speaking to the budget to actual and the investment holdings report. I did want to go down to item number 3, agreed upon procedures, which is audit related matter. I just wanted to point out, as I noted here, and I think this came up in a discussion with the treasurer yesterday. She was asking about internal audit, et cetera. We do have quarterly agreed upon procedures. The sample selections for the first 2 quarters, ending September and December, weren't done as of the time that I did this memo, but I did talk to our auditors yesterday, and they will be getting those sample selections to us for confirmation here probably in the next day or 2. I did want to point out to the council, and I think I pointed this out before, the quarter ended September and December are done together because of the time frame that the audit falls within. So we kind of cease doing or delay the agreed upon procedures until the audit is actually completed, and then they go back and catch up those last 2 quarters. We will have a deadline for those quarters of March 31st, and I wouldn't anticipate any problems with meeting that deadline. And then touching upon the other items within that memo, I'm on page 406. This is the budget schedule as of the end of December. If you go to the far right column, you'll note that we're currently sitting on budget savings of a little over $11 million. And for the new members, they might look at that and say that's a big number. It is a big number. I would point out, when we do the original appropriation request, we're doing those appropriation requests a full 20 months before the end of the fiscal year that they relate to. So because the market has kind of gone in a negative direction, we are setting on budget savings, and depending upon what the market holds through the end of the fiscal year, I would think most of those budget savings are going to hold. And then flipping over to page number 411. This is the summary page of the investment holdings report. I just wanted to go down to the bottom of the total managed net assets. And there's a follow-up slide to this. If you recall looking at the total page in prior months, I don't think you've ever seen a number as large as $41.2 billion. This is as of the end of December. And I'll point out in just a minute where those inflows came through are from. If you go to page 477, and this is all part of the investment holdings report, I just wanted to point out within the first bullet, I know there's been some discussions about inflows from the land office. We do note for this December report that the inflow was $219 million from the land office, which was a decrease of about $58.9 million from the prior month. And while that inflow's nothing to sneeze at, it is a decline, but it's still a very robust inflow, especially when you compare it to the prior year December contribution, which was $138 million. And then if you go down to the fourth bullet, I did want to point out a good part of the reason for the increases from November to December in the investment holdings report On that fourth bullet, we do note that the severance tax permanent fund received $897 million in December. And then the bullet below that, which is the fifth bullet, you'll see that the DFA transferred excess revenues to the Tax Stabilization Reserve Fund of $459 million. This was recorded as a receivable in our external audit ending June 30th. So they're actually moving the cash in December. We're very happy to receive that, $459 million. But if you go one bullet below that, you'll see that the Early Childhood Education and Care Fund received $1.3 billion that came in December. That too was recorded as a receivable as of the end of the fiscal year. So we had some substantial inflows to the State Investment Council in December, inflows that I've never experienced before. I can tell you when we're making transfers from us to our custodian of over $1 billion, we do get a lot of communication from the custodian regarding the timing of those inflows to make sure everything is proper on both our end and their end. And we didn't have any problems in that regard. And then lastly, I did include the audit report. I think it starts on page 481 of your material. Actually, maybe the page before that. Yeah, 481. I did want to point out this audit was submitted on time the day before Thanksgiving. We got authorization to actually finalize a report December 20th. I have included the entire report, just a couple of highlights. There's no audit adjustments other than adjustments that we make and provide to the auditors and catching up the lag for private investments as of a year in. That's the reason our report typically is a little bit delayed relative to agencies that don't have private investments. There was no findings as with the prior years. The entire report is there. It's fairly extensive, lots of schedules. If any of you look at that material and have any questions, want to reach out to me, I'm happy to shed light on any questions that you might have. And with that, the only other thing that I would point out, if you go to page 556 of the material, there was a discussion earlier about fees. You will note on this schedule, and this is a required schedule that the state auditor requires. It's unaudited, but much of the information is audited. For instance, all of our external fees, but you can get kind of a feel for not only the NAV as of June 30th, but also the management fee. And then for the private asset classes, towards the end of that schedule at the bottom, you can as well see the carried interest. And those fees are the basis for the study that RVK provided. So I just wanted to add a little light on that. And I'm open to any questions that anybody might have. Chair.
Thank you, Brett. Questions for the CFO? Okay, hearing none, we're going to go to matters of old or new business before the council. Agenda item 5A. Anything to report? I did want to just extend an invitation. I know that we have to ensure that we don't have a quorum at our committee here at our committee meetings, but the investment committee for new members is a great way to dig into especially the investment recommendations. I was attending those for a while. We have to obviously ensure that we don't have a quorum at those, but I don't think that we are close to that at this point. So that's available I believe the Thursday before the council meeting, something like that.
Madam Chair, now the Tuesday before.
Tuesday before.
Yeah, 1 week prior to the actual
One
meeting.
week prior to the council.
And I want to second I'd like to second what you just said. I think that over the course of time, a number of council members have chosen to attend the investment committee meeting, and I certainly would like to invite both Laura, Wayne, and all the other counselors that anytime you can, if you join that meeting, you can get in. You'll see a lot of these things in even more depth. So I think it tends to be really helpful, and also spurs you to read those 700 pages.
Madam Chair?
Member Messina.
Yeah, I just wanted to ask, how many does it take to constitute a quorum?
6.
6?
6, Madam Chair.
Yeah, 6.
Only
so there, I
six
believe,
or more than 6?
yes. There's
Only
11 of us.
6 would.
There's
If
11 of us, so 6 would be a quorum.
If I could just ask Evan or Steve or Vince, because we're recommending and not actually making decisions, is that applicable to us? And I honestly don't know the answer. But we're not making any. We don't make any decisions that have any reach other than as a recommendation to the council. So can you opine on that, please, Evan?
Yes, it does, because we have to notice meetings of the SIC. So if you have a majority of SIC members there, we haven't met our public meeting notice requirements for purposes of an SIC meeting. So that's primarily the reason why it becomes a problem.
So essentially the math on that, though, is that there are 3 committee members, correct?
Actually, yeah, there's actually, yes, and the advisor, who is not a voting member.
But the advisor doesn't count it as a quorum, does he, Evan?
No, the advisors do not. It's 6 members of the SIC. So if there were 3 SIC members at the investment committee, for example, Mr. Tejas, Mr. Messina, and Mr. Lavender, you could have 2 more before you started running the risk of tripping meeting notice requirements.
So I guess just maybe letting folks know that you're going to attend RSVPing to Andy so that we can ensure that we don't have a quorum.
Actually, there are 4 of us on the committee right now: Lee, me, Nick, and Mike. So there's room for one more to come in, I guess.
One more. There's room for one more.
Who made that rule?
All right. Anything else?
Madam Chair?
Madam Treasurer.
I would like to thank all of you for being so kind to me today for my first meeting and for the meeting that I had yesterday with all of you to get updated. I used to do these packets for the State Treasurer's Investment Committee when I worked under Treasurer Douglas Minge Brown. So I want to thank Andy and everyone that put these together. It was very helpful on page numbers and being able to follow, especially on a Zoom when you're not, face to face with others. So I would like to thank all of you, and our chairwoman, of course. You're amazing at conducting the meeting. So thank you all.
Thank you. It was great to welcome you and Secretary Props today. Hopefully we can all be welcomed back to the cabinet room very soon and be in person again together. With that, the announcement of our February meeting is that it will be Tuesday, February 28th, but we have yet to hear whether or not that will be in person. I would personally like to send a shout out and greeting to our former AG, who I see has joined the frame. So we're going to move on to agenda item 6. Charlie, do we have any public comment to be read?
Madam Chair, we have 2 members of the public joined us today. So
wonderful, wonderful. So if we could hear from
and
those individuals, and I don't know what the rules are, if they need to introduce themselves, but you can maybe get them up to speed on that, please.
Yes, well, I'll keep it very short. My name is Kenneth Segura Knoll. I'm with Invest New Mexico. Treasurer Montoya from Las Vegas, New Mexico. I went to high school with her dad. You're great. I've not attended a meeting at this that I'm more excited about to keeping this board in line in protecting the people from New Mexico.
Say something. This one here. My name is Michael Hidalgo. I grew up in New Mexico. Definitely love the state. Just wanted to say I appreciate this being open to essentially allow me to look at the wonderful work that you all are doing here. Very encouraged about the direction of New Mexico, and it's a beautiful thing to see. Thank you for letting me join. Thanks.
All right, thank you to the two members of the public that joined us. Did anyone submit written comments ahead of time, Charlie?
Madam Chair, I did not see any today, so I believe not.
Okay. All right, with that, we'll move on to a motion for adjournment.
So moved.
All right, we've got a motion by the treasurer. We've got a second by member Lavender. I'm actually not going to take a roll call vote on this motion. We are hereby adjourned.
Have a good day.
Thank you. Thank you.
We'll see everybody. Bye.